momentum, it's getting pumped, right? Obviously, I'm going to keep my stops tight on those ones because I know I can lose money. But if I'm trading a momentum stock that has breaking news and volumes increasing, and where like I go back on the daily chart and I'm looking at it and it's literally almost near the support or just breaking out from the support, or it breaks out over the resistance, then you know my stop's going to be a bit more wider and I'm going to be taking more size onto that trade, right? So, you know, with every strategy, you have to change your position sizing as well, right? According to the strategy, right? Like VWAP, we know stocks bounce on VWAP. So am I going to go in, oh, okay. Yeah, am I going to go in with a larger position? I'm going to explain all of that. First, we'll start with the imbalances, right?
Okay.
So imbalances is something that a lot of large cap, mid cap traders will do, right? They look if they see excess buy or sell orders. Right now, Nasdaq has a tool where you can pay for, and it'll tell you the imbalancer every day. I'm not sure how often it refreshes, but D2, if you're there, you might be able to lend me lend me a hand in this topic. D2, you there? No. All right, he'll mention that later then. So this one's really good because you want to see if it's more bullish and bearish, right? And imbalance is an easy way to find out. And there's two kinds of imbalances, right? There's the stock imbalancer, like where you can see individual stocks, and the imbalancer of the buy side versus the sell side. And you might see it on, you know, CNBC, they'll mention it, and other, you know, news broadcasters, because it is a big deal. Because when you see an imbalancer on several stocks on the same side, then you know there's going to be a shift in momentum or a shift in trend, right? And then they have market imbalances where the market's like, you know, whether it's bullish or bearish. Now, these imbalancers, it doesn't just have to be on the order side. It could also be something like the fear and greed index, right? That alone could help you determine if more people are going to be on the sell side that day or the buy side, right? So every morning when you wake up, the first thing you want to look at is SPY. You want to see how the market is overall, like how it is doing overall. Because most of the trades we do, yes, they're like, you know, smaller tickers, but once in a while we see value in these larger cap stocks where we can make like $5-10 on a trade, right? Like per share on a trade. So start with SPY, look at what the market's telling you, and then mark your lines on SPY. It's really easy to do. Just, you know, draw your support and resistance levels on a daily time frame, and then on a 15-minute and a 5-minute is what I usually use. And then throughout the day, all you have to do is just like take a quick glance at that SPY chart, and you'll like visually be able to see where the market's at, right? Now, I'm not sure any free resources where you can see the imbalancer, but we'll talk about that more later. Now, going on to arbitrage. So arbitrage, there's several ways to look at arbitrage, okay? So one thing is you can simultaneously buy several positions that, let's say, are in the same sector, and you'll notice that one let's say the tech sector, okay? Tech sector is going down, but then you'll notice that there's some tickers that are still up, right? And it's not one or two tickers, let's say 2-3 tickers, right? You pick the 2 or 3 that you do like, that you think that should take a pullback because the sector is going down or because the market's going down, and then you can make the money on that little price differences, right? Arbitrage again is usually done by like large cap or, you know, option traders, and usually happens at, you know, mean reversion, with the mean reversion technique, right? Oh yeah, and a good example of that is well, I forgot the exact term, but you know those tickers that are traded on multiple exchanges? Those are a good example, you know, like NAC, for example. You know, they trade on the Canadian exchange as NDM, and then on the US exchange as NAK, right? And there's days that the US market's closed and then the Canadian market's open, and then you can quickly make a little adjustment if you have the time to do that. Usually, like, these are all done by algos by now, so like those kind of arbitrage is really hard to profit on. Now, breaking news, that's my favorite one. Okay, and this is what matters, right? So if we are now, we already know that the market is never, um, I guess, what's the word, like, always correct. It's not like the price of a stock or the price of the market is never like definite, right? There's always some wiggle room. There's always some movement, or like even if it's trading sideways, it's always going to consolidate and move, right? Because there's no definitive price point that a stock or even the market should be at, right? There's people's opinions on where the stock should be at and what price point, right? So let's assume that the market is almost right? It's like plus or minus 5%. So when you get breaking news that people haven't expected or haven't anticipated, what you're going to see is a huge reaction, because they're gonna go onto that news and try and buy into it or sell into the news because they're expecting the news. And that's the two things that breaking news you really have to understand is it news that people were anticipating, or is it news that people did not know about, and everyone's going crazy on this news? Like, when you hear a buyout rumor, you see the instant reaction on the markets because this isn't something they expected. They didn't know it was coming up, stuff like that, like GME, for example, right? Ziggy, pick up a chart of GME too when they had that news. I think it was last week, Friday, I believe. Friday or Thursday. Thank you.
One thing go ahead.
And I'm just going to quickly go through the strategies, then I'm going to tell you how to employ which strategy onto which ticker. And you guys can look at tickers and tell me the background about those tickers, and then we can see which strategy would have applied at a certain time, right? Now, let's say catalyst. So upcoming FDA approval. So when we trade stocks that have, hey, look, this company got phase 2 data, it's approved, everything is good, it's just moving up, right? These are milestones and I guess conditions that they already had to meet. A lot of people already knew what was going to happen, right? That's why there's certain stocks that are in the FDA side that in the pharmaceutical side that don't actually move, even though they just got FDA approval, because the movement has already been anticipated and the price has reached the level that market makers or the big large institutions felt that it should be valued at, right? So some of them, you'll notice some FDA approvals, the stock goes up, like Givo, for example. The stock went up like crazy. It's only after when I started reading the news in depth that I realized it was a small percentage increase, that it shouldn't be valued this high, right? But at the time, everyone's going crazy. It's a high momentum stock. It's a low flow with 1.25 million on the float. So we knew it was the best, I guess, perfect storm, right? Momentum stocks is my favorite. Like if you're a day trader, you really got to know how to play with volatility, and the most volatility you get is usually in the morning, and playing the morning is important. Like I've told you guys many times, like try and get up at early at 7:30ish, and try and trade pre-market if you can, if you have the ability to. It's really important to set your day off right? I find days where I get that one trade. I don't care if it's $100, $1,000. It really doesn't matter to me. If I get that one trade and it's a winning trade, my psychology is set for whenever the morning spike opens. Like as soon as that bell rings at 9:30, I'm more active, I'm more ready, and I'm more likely to execute trades faster, right? So yeah, momentum stocks, we'll get back to that one because that's something that we have to trade. We're day traders. We don't make money unless there's volatility or momentum behind it, right?
And I just one thing, TJ.
Yeah.
Like you're saying, like it's so important, especially when you're beginning to be here at the beginning of the days and like when the market starts, not only to capture volatility, right? But because you're still trying to understand how the market is working. So like you were saying, like plotting your SPY resistance and support levels, it's going to take you longer to do that, right? It's going to take you longer to get situated, to get an idea of what's going on in terms of the overall market, so that you can gauge and make sure that your sentiment gauge of how you think that things are going to go today, are actually, that's how things go for you. It's a preparation thing. And like if you're starting early, I think it's like not even a choice. I think you most if you're new to trading, you most certainly have to be here at market open, because you don't know all of the in between, all of the fluff that happens on a day-to-day basis. You're still unfamiliar with that. So you need to familiarize yourself with how stocks dip or rip in the mornings based on sentiment, based on where their previous price action was. Like, all of these things should matter to you, because when you figure all of these things out, then you can trade at any time of the day. You can miss the first. You could sleep in if you want to. You can do whatever you want, because you're going to be able to trade at any time, at any ticker, at any point in time. So, like, it's very important to, you know, to invest and to just treat it seriously and, like, try to learn. And the best time to learn is in the mornings when you're getting heavy volatility and heavy volume, right? Easy trades.
Yeah, and you know, like, we are lucky. Okay, our group, you know, there's so many people on the Catalyst team, and honestly on our team that try and find the news relatively early. One thing I want you guys to do, and this is something I do every time I wake up, is just look for CFA's post. Okay, CFA, I'll just post it right now on our chat. You know, look at this post. It tells you everything you need to know, and so fast. You know, like. There's one thing about Trade Idea Scanner. It's like it doesn't tell you the news behind the movement, right? This one, it tells you exactly what's going on that ticker, like LTBR, awarded U.S. patent for metallic nuclear fuel assembly design. We know that right off the bat. We know why it's running. This is beautiful. I knew that this was going to be a stock in play, and we should be looking at it. And CLBS, we knew it was a follow through from yesterday. Things like that. And, you know, not just that, you can actually see how the future side is doing. Because remember, a lot of what we trade, except for like the, you know, sub pennies and small caps, is actually judged by the futures market, right? It's the most important thing to track. You want to track the futures, especially the SPY. You want to look at, you know, if you're into gold, if you're one of those JNUG traders, you want to look at the gold side. You want to look at the 10-year yield. That's important too, and crude oil, right? And we still have trades, even like if you take a look at if crude oil is running, right? Let's say crude oil jumps like 1%, or even more. Like we can trade low float tickers like NOG, or, you know, there's several low float tickers that we trade. Let me just pick it up. Right, so these are the low float tickers that we know that will run when oil runs, right? So yeah, that's one example. Let me go on to the next one. Oh, what's that? Oh, yeah, unusual option strategy. Now, this one is a really tough one that we can't really cover in this lesson, at least, because there's so much involved, right? Like, so you really have to think about it this way, right? Someone always knows, okay? It doesn't matter. Someone has a friend. They maybe went to Wharton together, or who knows, like they were in the same, like, I don't know, frat or something. And one guy's a CEO of, let's say, Coca-Cola, you know, or CFO, who knows? And he has a buddy, and he's like, hey, buddy, I like, can I invest in this? And he'd be like, hey, listen, you know what? Next quarter, we're going to be doing good. We should have a good earnings. And now that guy's thinking, okay, what's the best way to capitalize on this inside information, right? The easiest way is options, right? It's a nice derivative. You can literally you can get the most bang out of your buck by trading it on the option side. Now, if these kind of things are usually really fast, you know, inside information is for information that's going to happen within, let's say within a 2-week period, right? No one's gonna, like, if it's gonna be longer than 2 weeks, people are gonna scale into it, so then they don't get noticed, right? And people don't follow their trades and just make the stock just like go up prematurely, right? Because if no one knows about it, the moment news hits, the first thing that's gonna happen is it's just gonna skyrocket fast, right? And that's when those guys are gonna be making their money. So that one on its own is another lesson, but you really want to look for those call sweeps, put sweeps. You want to see if it's on the bid side or the ask side. You want to look at the chart and see the overall trend. You don't have to technically buy into it at the same time. You can just wait to see how it plays out, and then you might get a sense of which way, which direction that they're planning the move, right? Whether they're shorting it or long. Another way to look at it is, let's say the market's going down, right? This is a video that I posted in the Options 101 channel. And let's say, you know, you're looking at, you know, SPY, and SPY is tanking in the morning. But then you see that, hey, there's these call sweeps coming up, right? On the ask. What is that telling you? That's telling you, yeah, it's tanking over here. People are getting scared, but there's bigger institutions lining up And that smart money is ready to just buy it back up at a cheaper price, obviously, right? And that one's really complex, so we're gonna save that for another lesson. Reversals, trends, and support and resistance. So I like to look at this as the technicals, okay, not the technicals of while we're incorporating volume or any of the indicators. I'm just looking at the actual technical formation on the chart, right? So I like to have, so these are the strategies that we use, right? So, you know, everyone knows where to buy on the break of, you know, flag. Everyone knows where to get stopped out on a flag breakout. Everyone knows those triangle breakouts, where to get in, where to get out, right? You know that it's easier. You know, you might attempt to get into the, let's say a triangle breakout, right? The third time it hits, usually it might break it, but usually it happens on the fourth, right? So that fourth attempt, you have some data saying, oh my God, we finally broke that resistance. This time it could run. I'm going to get in on that breakout and put a stop loss just, you know, tightly underneath, right? So, you know, that's another example, because like, I guess it's called the law of oscillations. Like, you'll have huge movements. Let me just post this. I forgot what the actual thing is, but I'll find it later. But pretty much you get huge movements, and then it starts consolidating, and then it's just like coils down into a certain price point. At that price point, it's telling us that the buyers, sellers are gone, and it's ready to make a drastic move on one side or the other, right? And we're just waiting for that smart money to make that move or the decision for us, and we follow that trend. Reversals are easy. You know, let's say a stock tanked. You know, we're looking at Starbucks now. All right, so I just pulled up a Starbucks chart, and you know it looks so attractive over here. You know, these are like Frank said, these are 52-week lows, and honestly, if you scroll this back to like 4 or 5 years, it's Starbucks been in this little channel, and it's at a nice, okay, not 4 or 5 years, 3 years. This is a nice level. If we can maintain this level and stay over 50, I could see this as a reversal opportunity for us to get in, right? Ziggy, you want to post that chart for them? Just like a weekly chart on Starbucks, SBUX. And the VWAP. VWAP is important, you know, guys. Like, it's one of the indicators that a lot of traders and a lot of institutional traders use. It's like, you know, it's bullish over VWAP. It's the average weighted price, weighted volume weighted average price, right? So it's something that everyone looks at, and it's something that we can use as an indication of where people are buying into this trend, right, or this trade. And usually, like, let's say IPOs, I love just using VWAP on IPO, because then it's easy. Like, it's a long over VWAP, it's a short underneath it. If we're ever shorting IPOs, it's one of the easiest indicators to use. Every other indicator is technically lagging, right? So this one's really nice to use. And of course, you know, you gotta tie any of these strategies in with the volume, right? If the volume is telling you that it's ready for a move, you know, follow that volume, because volume precedes price. Now the short interest. Now this is in, like, all these strategies are just like things that are gonna make the stock move one direction or another, right? And short squeezes are my favorite. When I see a high short squeeze, like, you know, let's use Jiva for an example. We know the float is 125 million. We know that there's 1.25 million is the float. We know that there's 1.2 million shorts. So the moment this starts moving back up, we're going to get a large short squeeze, right? And whenever that thing, you know, Jivo comes back on my scanners, I already know what I'm going to do. I'm going to go in heavy with the confidence that shorts are going to start to cover, right? And their cover will be my profit. And next, it's like using your indicator. So I like RSI. That's what I use. I know Frank uses DMI, stochastics, and RSI together. You can use any combination of indicators that works for you. You know, whatever makes you confident, use it, because it's like, an indicator that works for me doesn't really work for any, you know, some other people. It just doesn't. It's not a one-size-fits-all solution. However, I do suggest using one kind of like indicator. Like I love RSI. I'm a big advocate in it. I use it every day on any time frame really. You also want like a volume indicator, because kind of like the OBV. The VZO is really nice. So if you're using TOS or TradingView, you can always use VZO and PZO together. And we have more detailed descriptions on the VZO and PZO. I think Ziggy, you made a nice what's it called? A nice post about it, right? Article on it.
Yep.
And mean reversion. So this is my favorite, right? Mean reversion, because remember, like stocks, I like shorting now because of this broker that I have, you know, a ridiculous amount of shorts on ridiculous tickers that I never was able to short. So, you know, for the time being, I'm gonna be shorting things just for the hell of shorting it, because I'm now able to short these tickers. But realistically, mean reversion is just not on the short side; it's on the long side as well, right? So if a stock's tanking really low, and like Johnny did, you know, when Devo went from, what was it, 18 bucks down to 11 bucks, and you know he bought it at like I think 13. He didn't worry that it went to 11 and it went $2 against him, because he knew that it's gonna have to reverse at one point, and if you wanted to, you can add on to it, right? And mean reversion it's one of the best, because when you're following a trend, right, it starts to go down. The first thing that's going to happen is an initial impulsive move on the downside. It's going to move down quick, and then it's going to consolidate. And if there's no buyers at those levels where it consolidates, it's going to go down again, right? So 2-3 times after it does this, what's going to happen is like it's going to reach a point where buyers are like, okay, it's overextended. We can maybe catch a knife on this, or you know, or it's gone overextended on the upside, and we can just short it, right? And at that point is where also shorts are going to cover, right? So let's say we're talking about a long position and it's just like the stock just tanked, right? Shorts will start to cover at a certain point, and then that will feed it. That'll make it like a feeding frenzy, and the stock will just move back up, right? And at a more violent rate. We've seen that today on a couple tickers. Like what was that new NEW? Ziggy, if you can post a 1-minute chart of NEW highlighting the 10 p.m. Sorry, 10 a.m. to 12 a.m. 12 p.m. I mean, just on today's.
One thing I just wanted to tack on onto mean reversion is like when I'm talking about the guaranteed move, that's what I'm talking about. Is like going back to test your mean, right?
All right, on that chart, it looks a lot smaller on the movement, but it's a huge move. Look at the sides; you can see the price points that it moved down, right? And this is what I'm talking about: impulsive move down, consolidation, buyers aren't stepping up, another move down, and then it just keeps doing that until it hits a point where, you know, oh, there's a huge, there you go. You can see the huge move there. And that was so impulsive. We knew that it's going to retrace at least like, I'd say 20%, right? That's what we said on voice. And literally it did. If you draw Fibonacci, it came back up a bit, and then, you know, went back down to with its original trend, right? That impulsive move is buyer stepping up and shorts covering. Shorts are like, okay, I made enough profit. This is a good price level. And more importantly, stocks that are like this, which is like traded more institutionally, you can bet that there's smart money like, okay, I'm going to pick this up at this price. And if you actually look on a daily chart where this price was, it was on the daily VWAP. So not on the intraday VWAP, but on the daily VWAP. It literally stayed around that price. So the moment it dropped below daily VWAP, they're looking at it like, okay, this is a good buy opportunity. I'm buying it cheaper than what most of the market is buying it at, right? So that's how everything ties in together. What's the next strategy? Low floats, guys. Like low floats it's difficult, because if there's a lot of volume and the float's getting rotated, Yes, there's a lot of extreme price action, and that's the ones we love. Because come on, who doesn't love making 10% in like 5 minutes? Everyone does, right? But then again, you can also lose 10% in 5 minutes or even less. So, and when stocks tend to fall, especially low floats, they fall fast, right? And as soon as it falls, remember the people that are trading low floats as well, right? Those are usually retail traders. So when those guys get, they're in a losing trade, what's the first thing they're going to do? They're going to panic and they're going to sell. Well, most of them are going to just try and get out at the bid, or some of them might have tried to get out on the bid and the bid moves down and they couldn't get out. So then they cancel the bid and do a market order, which is why you see like drastic moves, just tanking a stock. And we have like, RKDA as a good example of that. There's so many other tickers that they are like parabolic pumps and dumps, right? So you really got to be careful with it, but there is strategies to trading it. Don't use a large amount of size, like let's say on average, right? Let's say each trade we make 2%, okay? So let's say we go in with 5,000 shares, we make 2%, we're happy, okay? Um, on a ticker that's a low float, we only need 1,000 shares to get the same amount of profits as we would have if using 5,000 shares. So don't go full size, don't go even half size. Um, take it with I guess a grain of salt. Don't just think that it's going to continuously move up, because we don't know what price people got in at, right? So that's why multiple time frame analysis is important. You want to see if you're getting an entry close to the support. If you are, then it's a safer entry. Worst comes to worst, you might have to average down quickly and get out of the trade at break even, right? And watch for volume. Volume precedes price, right? So, when there's volume, and try and look for not the small orders, okay? It's easy to get caught up on the tape. That's why my tape, I made sure that I don't see I don't see any transactions under 99 shares. Those trades don't move the price. Those are just trades. People are just buying into it or selling into it, right? Those aren't the ones that I'm looking for. I'm looking for the big players, the guys that are doing like 1,000 to like 5,000, 10,000 share lots, right? Let's say on something like Givo. Those are the guys that are going to be moving the price. Those are um, the people I have to watch out for on the tape and see where they're going to come on, and then watch the level too closely. Like these large cap stocks, they have so much liquidity, right? These are tickers with a lot of volume and a lot of like average volume, right? Low floats, they're larger relative volume, relative to their average volume, right? They're trading sometimes, like I'm looking at NEPT, and what's NEPT's RVol? I think it's 20 times RVol. That's crazy. So it's trading 20 times its average volume. And I'm looking at the stock splits reference. It's like the stock splits activity on it alone is up 11,000%. That's telling me so much information right there. That's literally telling me. Oh yeah, there you go. Thank you, Ziggy, for posting that. That's telling me everything. That means people are bullish on this ticker. It's gonna move up. It has to move up, because look what the price is telling you. It's moving like, volume precedes price, right? And the volume's telling you that everyone's bullish on this ticker. Now the next one would be parabolic pump and dumps. Now this ties in with like low floats, right? Like there's stocks that just can't hold its gains. Let's see, what's an example of one of those tickers? Someone call a ticker that's a good example of something that just spikes up and drops the same day. Oh, not Dries. Okay, Dries is actually doing good so this year.
I have an example for us.
Sorry, go ahead. Don't say Cali.
That one is, but I wouldn't do that to myself. I get too sad.
All right.
More than one. We could hone in on one particular one if we want, but I had notes on this.
Oh, beautiful. That's a good note. See, like, look at that. Is that a multiple time frame analysis on it? Like same ticker, different time.
No, that's actually showing all different kinds of companies that are the pump and dumps. So they're all on 5
Alright.
minutes right there.
Perfect. And I want you guys to look at that. Again, this ties in. Like, remember, trading is holistic. You got to take everything and you just got to put it together in your trading strategy. And like, before we get into trade, most of us, actually, I hope all of us do, we look at the daily chart and we look at what happens on that ticker when it does pump up on large volume. And you'll see there's the volume, there's the pump, and then it drops and it doesn't hold its gain. So what are we going to do on that ticker? Are we going to go in full size into that ticker? Hell no. We're going to go in with maybe a quarter of the position that we normally would. But we do know that, hey, if we get it near the bottom, hey, you know what? Maybe I'll risk 50% of my average, like the normal position size. We get into that trade and then we milk as much as we can. And as soon as it starts, falling down, you get out of the trade because this trade is telling us that it doesn't hold its gains well, right? Especially if there's no catalyst behind it or news, anything like that. If there's nothing behind the move, then you know it's going to be hard for it to hold. Now, this does not mean those technical breakouts, right? Like traders like Stock Authority, he looks for those technical breakouts where it's like, hey, the stock went down and it's ready for a reversal, and he's amazing at defining those, and that's his strategy, right? These are really difficult to trade. Like, so what I like about low floats is buying at, like Stock Authority does, right at the bottom, at the lowest price, like ALT, right? I think he bought it like 40. He alerted us at 40 cents. I think he bought it at 40 cents, and he keeps trading it. You know why? Because it's never gone back to that 40-cent mark, right? So for him, it's like, hey, I've made money on it. I can make money on it again and continuously make money until it starts moving up. And he knows it doesn't hold its gain, so he's not playing it every day. But as soon as the price goes down to an acceptable level, he'll buy into it again. And I'm assuming that's what he does. I can't really comment on it, but that's what I would do at least. Oh, nice. And Ziggy posted that 6 stages of pump and dumps, and we don't have to go through that. That's another topic that we've covered many times before. Next one I'd say is high beta technical. So let's say the JNUG crew, we have a nice JNUG JDST following, and what they do is they just play the technicals on the same ticker, and there's nothing wrong with that. I know traders that trade like Momo, AMD, Amazon, Tesla all day, every day, right? And they have a system, they have a trading system that works, and they're fully confident on it. They know the ticker, they know how the ticker reacts, and the same way how we trade SPY options, right? We know how SPY is going to react. It's so much easier for us to do a mean reversion trade on it and make some good amount of profits, right? Now, high beta essentially means it's pretty much, let's say, so the market itself, right? I forgot if it's 0 beta or 1 beta. I forgot what the actual number is, but pretty much so let's say beta is man, I'm gonna have to research this one because this is like, let's say it's a measure of like the volatility. Okay, there we go. Thank you. And what we look for on a beta stock is something that moves with the market. So a stock that has a low beta would essentially, now correct me if I'm wrong, I sometimes get them two mixed up. Oh, there you go. Thank you, Ziggy. You wrote it down there. But essentially, if it's a low beta stock, it means it should move with the market and it's more closely tied with the market. There's stocks that are high beta that doesn't follow the market, like Tesla, for example. Okay, I don't know if it is high beta, but it definitely trades like it definitely trades against the markets on most scenarios, right? And that's a good example of a high beta stock where you can make money even though the market is, stagnant. Now, high beta trading is usually an acceptable way to trade when the market is dead, when the market is slow, there's no volatility, and almost all of last year you could have just traded high beta stocks if you wanted to day trade them, right? Again, with low beta, on last year when the market was just going on like a 45-degree climb, all you had to do was just find the stocks that are, you know, going with the market, and then find the ones that you like at a relatively good price point, and trade those tickers, right? Or buy options on it. And honestly, options would be a lot easier and worth your while when you're trading with the market, or on large cap tickers, right? Oh man. All right. What's the next one? So high ATR, right? So there's a average like true range on a ticker, right? Now, you know, all tickers are different. Essentially, when we're day trading, what we're trying to do is capitalize on as much of the movement as possible, right? So when a stock is trading above its ATR, it has more volatility, it has more price action than the actual than its average, right? So those are really good. When we see stocks that have a high ATR, we automatically know that, hey, we can probably target, let's say it's 30 cents. We can target 30 cents, but we can make, you know, 10 cents off of it, right? We know we can make 10 cents because the average movement on that ticker is about 30 cents, right? And it helps us on the risk side too, right? How much are we going to put a stop loss? We already know how much the ticker usually moves on an average basis, so it's easier for us to base that as our stop as well, right? Does everyone follow? Yeah? You guys there?
Yep.
All right, perfect. That's honestly pretty much everything. Like Ziggy put all the notes down. I just wanted to explain the strategies itself. Now remember, this isn't one strategy. You don't just employ it by itself. You need to use everything in conjunction with others, right? Like obviously indicators and a chart pattern, really strong, right? If it's backed by any catalyst, the upcoming catalyst, or, you know, relative news or breaking news that just entered, obviously it's going to be a lot stronger, right? Those kind of trades, we can put a lot more money into the trade. And this is the thing, right? Like, we can't always hit home runs, right? But if every day we can slowly make money, okay, we can make it at, I don't know, 1% a day, okay? If you can increase your portfolio 1% a day, holy shit, you're good, right? And let's say every week we can make 5%, okay? That's the money that's growing our account at a good and acceptable rate, right? Keep in mind, hedge funds make like 20% a year, okay? So for us to make 5% a week is, you know, it's amazing. But let's say we make 1%. Let's say we make 2% in a week, right? But then there's those tickers like Jibo where everything just combines. We have a low float. We have a ticker that's relatively low. Like, where was Jibo? Let me just check the chart. Yeah, it was literally near the bottom, right? It was literally near the bottom. No interest on the ticker. Then out of nowhere, this news hits. We already know what's going to happen. We already know. Look at the volume. Before I woke up that day, it had 6 million volume. This is a ticker. The first thing I looked at, okay, Jibo, we recognize this ticker. It ran like a couple years back. I've traded it before. I've made money on it. So the moment it came back, I'm like, what is the float? As soon as I knew it was 1.25 million and we have 6 million traded volume, we know the float's been rotated at least 5 times. We know what to do in those situations. You go in, you find an entry, you find a little pullback entry, maybe the 20 moving average, maybe VWAP entry, but you take that position, and because there's a catalyst behind it, we stay in that trade longer, right? We're not afraid that Jiva's going to just spike up and down, because if you really look at the 3 or 4 year chart on this thing, it does spike. It does spike and come down once in a while, but when it does spike and when it does move up, it moves up drastically, and it moves up not 1 day, usually 2 days, which is why we didn't, you know, short it on the first day and hold our short overnight. Doesn't make sense to do that, right? And a good thing we didn't, because look what happened on the second day, right? So you want to hit home runs when the opportunity presents itself. Those are what's going to drastically increase your account. And then every other time, you just got to learn to survive, right? And if you can do that, you will be profitable, you will be consistent, and you're like, every day that you are trading, you're building your skills, you're building your skill set. That's why I want you guys to trade, not just like sit around and wait for that A plus setup every time, because honestly, we don't know when an A plus setup is going to come. And what if you miss opportunities just because you missed a B plus setup just because you wanted that only A plus setups, right? And then you get into that A plus setup with a large size, and then you just tank your account. It's going to be so much harder to recover from it. So always try and gradually increase your account size, but on those heavy hitters, hit it hard. Right, and that covers almost everything. If you guys have any questions, let me know. Oh yeah, we can go over indicators too, but if you guys have questions, just type it in the group study chat, and we'll have some time to answer all of your questions. And don't be shy, guys. There's no wrong question, or yeah, there's none. All right, so I got a question from Joel. He was asking me, can you repeat why Jiva was a home run? So look at the okay, I'm looking at a 4-year chart on Jiva, daily, weekly chart, and just look at how it moves. When it spikes up, that thing just runs. So we can see that from the history of the trade of the ticker, that when something drops, like news drops, it runs. This isn't the first time this had 50 million volume in a week. You know, it's not the first time, and it won't be the last. If you look back on a 4-year chart, Ziggy, do you mind posting, like, let's say a weekly chart of a 4-year weekly chart on Jivo?
Yep, I got you.
Thank you.
So this would just be an example of a rise. I need to go closer, obviously.
Oh, post the Jiva one, because that one's the easy one. And the poster
No,
with the
that
volume.
is Jiva. The chart is just
Jiva.
really
Okay, okay. If you can, post it with the volume, because I just want to show everyone the volume that Jivo usually has when it does run. Honestly, even a 2-year chart would be fine. It's like try and get December 2016.
Yep, I got it. 1 sec.
Oh yeah, guys, if you can, just follow us on YouTube. It'll really, honestly, it'll help us. If we can get more followers, that would be great for us. I don't think we're gonna make money off of YouTube, but hey, one can dream, right? So VWAP, it depends. T Davis, you have a good question there too. Man, I don't know why yours doesn't show it again. I'm just gonna post this one. Let me just do it quickly. So this is what I see on mine. Like, it's probably wrong because I'm using a shitty CFD broker. But here's how I see it, right? I see the volume, I see the spikes up on volume, and I see that it tries to hold the gains. There's one time where we had massive volume and it couldn't hold any gains, so that's the one that's marked with X. But the other time, it gaps up and then comes back down. I'm not sure if it's reverse splits. I don't know how this platform does it. Relatively new to this platform, but essentially I see this and I'm like, oh, nice, okay. And I do remember trading this ticker a few times, and when it rips, I've made a good amount of money on it several years ago. So I was like, what the hell? We should trade this, and we went long. And I didn't assume that it was going to go higher than 6, but when it did, then that was our indication that this could continue, right? Also the volume. The volume was so good. I think the first day we got over, like, I forgot how much volume did we get the first day? 60 million? 50 million? Oh, 30 million. Okay, there we go. 30 million volume on a ticker that have 1.25 million float. That's a lot, guys. And that we already knew what was going to happen after. Now, T. Davis had a question, and it's about the VWAP. So it's really hard. AETI, I think, is a bad example. Actually, it's a good example because AETI had everything that made it look attractive, right? We had the chart pattern, and the chart pattern was telling us, hey, you know what? Early morning, Ziggy posted, intraday chart on AETI if you can. So we saw that, hey, we got a nice spike up on volume. It went over VWAP, tested the 170s, came back down. Market opened and it just tanked. Found support. I have my, like, what's it called, pivot points, which was around 125. So around that area, you saw that buyers stepped in and brought the price right back up. We got over the VWAP. The first time it tried to go over VWAP, we got rejected, came down, tested the 130 level, and then it just skyrocketed past VWAP, and we trailed VWAP all the way up until, the 160 range again. At the 160 range, we had some 150, 160 range. We had some consolidation, which is good because that was an extreme move up. And we started to see another, I guess, pump right up, and that was on good volume, right? If you can see it on that chart, it was on good volume. We pumped it up over the 150, and I think I don't know if it was this trade. No, it was. We were talking about this over 150, 170. That it's good, right? Actually, it was 170. Over 170, we break over pre-market highs. We should go in on it, and a few of you guys got in on it and got it up to the 190s. We retraced back to the VWAP. Held it. We held that VWAP. Now you notice that there's that drastic down, like huge candlestick on the downside. So you're gonna see that it goes underneath VWAP. Like, I like to use this rule when I look at a chart. When I'm looking at support, I'm not looking at it as a definitive number, but I'm looking at it as an area, right? Support and resistance. I'm looking at those areas. So if I'm ever confused on where I should enter a trade, just put your, like, pinky over your chart and be like, okay, there's the line. I'm gonna put my pinky right in the middle of that line, and then you have like a little plus or minus factor, right? So we saw that it went down. As soon as it started reclaiming VWAP, we knew that, okay, this is a good entry. And relatively speaking, look at that 150, 160 level. That was a level that we were consolidating in. And if you look at Ziggy's chart, you can actually see it with the green lines and the red lines. Those are the support and resistance levels on the TTN scalper. We've actually found one that takes away those stupid arrows and actually visually represents different levels that we should be looking at as support and resistance, right? And look at that area. That area was a strong support / resistance area the entire day, right? So we go into this trade. It's above VWAP. It moves up. We try and test that 190s. Couldn't even get up to it. As soon as we got rejected off that 190s, look what happens. And look at the RSI as well. That RSI was telling you, okay, it's going down. We tried going up. We tried breaking divergence. We couldn't do it. No, not enough strength, not enough momentum. So much red. That's one more thing I didn't like about the trade. even though the chart looked nice, so much red candlesticks, right? And then it started coming down, but every day, like the whole day, we're just trying to reclaim VWAP and move up. But one thing you'll notice why we didn't take this trade today, and Frank will tell you, is like the chart pattern was beautiful. We had higher highs going into the afternoon session, but what happened? We just didn't see the volume, and without that volume, there's not going to be if someone's not going to buy it at the 150s, then what makes us think that they're going to buy it at the 170s, right? It's just unreasonable. They're not buying it, so we stayed out of that trade, and we knew that VWAP was going to get rejected, and we're like, okay, let's see if it holds support at 150, and you see that drastic move down around what time was that? Around 3 o'clock, you see that drastic move down, and buyers stepped up and tried to get over VWAP, and again, rejected off of it, came right back down. Then this time, 150 couldn't hold. And yeah, that was the end of the story on that one. On larger caps, now larger cap stocks, let's use, what's a good one? Yes, MU, we had its earnings today, so that was a bad one. Oh, IQ is a good example. Now, this is a stock that is really violent on its movement. I'm holding on to it as a swing, but there's a lot of people that is just day trading it, and it makes sense because if you look at the 5-minute chart on IQ for the last like 5-10 days, you'll notice something. Those dips under VWAP are just buying opportunities. The more that it deviates above VWAP, those are selling opportunities, and you just keep continuing to do this. Buy it on the break of VWAP and then sell it when it gets overextended, and you could literally make money on this every single day. Even though the ticker is moving up and down, it was technically easy, except for yesterday we had that violent move down. You would have got stopped out over there at like the 42 level, and that was a scary level. I was like, okay, tomorrow if this doesn't move up, I'm gonna get out of my position. But this is how that trade like really correlated with its VWAP. It's really beautiful. You can take those as huge buy opportunities when it deviates away from it. Now, deviating away from the buy side, it's also like, let's say we're looking at a stock that's running. So what's a stock that ran? Ziggy, can you post the CLBS charts for pre-market, including yesterday's after hours? Actually, including yesterday, and then just pre-market. Perfect, thank you. So look what happened on this trade. We were watching this yesterday. It was moving at slowly, nicely, and I know a lot of you guys got in. I was like, I don't know, it's not moving enough points for me to get in, and I didn't take the trade. And then look what happened after hours. I wake up and it's just up. But look at that deviation from that VWAP, right? You see a drastic deviation. So a lot of people got in at that price around the $6 level. Now, if you Ziggy, if you can post what happened today afterwards, that would be great. And note how the stock was trading at the $8 range, right? That's very important because now we know, like, if we break under, if we can break pre-market highs, what's going to happen? It's going to go down. How far is it going to go down? Right to that $9 to $8 range. And today, when it's trading, it traded at that range. Now, if we think it's going to go lower, where are we going to take it? We're going to take it down to $6 because that's where that VWAP line is. That's where majority of the people that got in early would be looking to exit, right, if they're still in the trade. And that would be the next support level, right? If I wanted to dip buy it, I wouldn't buy it at 8 because it absolutely did nothing today at $8, right? But at $6, maybe it'll push back up. Maybe shorts will start squeezing, covering, and then, other shorts will get squeezed on the trade. So I guess that's the easiest way of explaining it. All right. Any other questions? Oh, and Frank, feel free to add in anytime. Because remember, these are all opinions. This is my opinion. Everyone has their own. And, you know, Frank has some really good insight that he could share. And any of you guys, if you want to add into this.
No,
Why don't you go over some multiple time frame analysis? Because I know I used to struggle with that, and that's probably one of the hardest things to get a hang of. And then once you got it, you got it.
Okay, yeah, we could do that. And I think Ziggy, our indicators that we made on your chart and stuff, I think it's the easiest way. So try and post like full charts that include the volume and all that, and your indicator, like the RSI indicator and VZOs, because then we can see how everything incorporates and ties in together. I'm just going to quickly answer Joel's next question, which was the difference between relative volume and average volume, right? So average volume is just, I don't know, it could be tracked for the last 20 days, 50 days, 100 days, or 200 days, right? It's the average volume that that ticker has. You know, it's just like a moving average, but on the volume side, right? You can easily put that on your TOS indicator, and you can have your average volume. I think we do have a label for that, so you can see it. Now, relative volume is like, you're looking at what is the current volume and how much greater or less it is from its average volume, right? If there is higher relative volume, and if we believe that volume precedes price, then we would be looking for stocks with higher RVOL, because that's the stocks that are going to be in play and that someone is buying over the average volume, right? And they're buying it for some reason. So we got to figure out what the reason they're buying it for, and if it's something good, and if we agree on it, if we see a chart pattern, if we see it's at the bottom and there's that support and selling pressure decreasing and buyers are increasing, okay, we already know there's the trade, right?
What chart am I
So
posting?
Trojan, that's not a pivot point. That's our TTM scalper. I think we have it available only to our upper echelon members, where they can actually go into our TOS scanner idea, TOS scripts, and pretty much you'll be able to download it yourself. This is the setup that I use, and I know Ziggy uses it because obviously he's using it right now. I use a lot more labels, but together, like, I find it so much easier to see support and resistance levels, especially if you, like, right now you can't really see it because we're scrolled out of the chart, but let's say, Ziggy, if you can post a 5-minute chart on, like, where you can actually clean, like on what was it, CLBS, post a 5-minute chart, and you'll clearly be able to see where the definitive support range and the resistance range is, right, throughout this day. And I like that over the regular TTM, where it just gives you an arrow. It's a TTM scalper. Essentially, it's the same indicator. But with this, I can see it. I can visually see which number it is. I don't have to, like, put my mouse over the chart and then, you know, look for the crosshair and see which price point it's at. And Ziggy, if you don't mind, we'll share that script for the TTM scalper later on today after the lesson. You know what? You can just DM it to Trojan.
All right.
And there you go, Trojan. So there's the picture. You can visually see everything that's going on over there, right? It's so much easier, cleaner to see. Now the next thing is so yeah.
I'm sorry. Are we talking about multi-time frame?
Yeah, we're gonna start that topic. Ziggy, do you want to open up a grid and on the grid have, you know, a 5-minute, 15, and a daily?
Well, can I just show a quick example?
Yeah, sure. Actually, yeah, fine. Go ahead. Take it away.
So let me just show like a quick example of like how it's so important to like always take as big of a look as possible, right? It's like not as relevant to day trading, right? Because you're trading a much short-term move. But in terms of gauging sentiment and where a stock is over an extended period of time, the more time that you use, the bigger your time frame, the more data you have, right? So that's just basic like logic, right? So let's look at this example. Like, this is probably not the best example, but let's look at Tesla, for instance, right? So everybody who's sitting in Tesla right now, I mean, I'm sure you guys are aware, Tesla's ripped recently, right? So you look at the daily here, right? You see the daily, Now, what I was playing on Tesla was the daily MACD cross. When I was long at like 275, up to 320, that's what I was playing. I was playing this daily MACD cross, right? So I know from my own experience that a daily MACD cross is going to, generate more volume and more price action than a 4-hour MACD cross. It's going to generate less volume, less price action than a weekly MACD cross, right? Makes sense, right? Higher the time frame, higher the weight, more weight, more of a move, right? Logic, okay? So if you're looking at the daily time frame on Tesla, and you're wondering about your position right now, you're saying to yourself, do I need to sell my Tesla position, right? Is there still an opportunity to make money long here? And if you're looking at the daily, you're thinking to yourself, the daily looks pretty topped out, right? You see the RSI topping out overbought. You see the MACD coming over, reaching that new high there and looking to taper off or consolidate, if you would, sideways. And your stochastic turning down, right? So one thing I always tell people to consider is the adjustment in these indicators, right? So you can see how we grinded up from 40. This is not really what we're talking about here, but I just want to always exaggerate this. Adjustment of indicators, right? So we went from 40 RSI to 80 RSI on this daily move, right? Now, we're questioning our position, right? We don't know how strong our position is. So what I do is I go to the weekly, right? If I'm trying to figure out how strong my daily position is, I'm going to look at the weekly chart. So then I go to the weekly chart and I say, okay, I know what the daily is. The daily is topped out. It's hammered to the sky, right? I know it hit overbought. The MACD is hammered, looking to consolidate, taper down, and my stochastic is turning down. So then I'm thinking to myself, okay, I know where that's at. Then I go to the weekly, right? It's a completely different story with the weekly, isn't it? You see how it's a completely different story? The weekly isn't topped out at all. In fact, the RSI on the weekly, in my opinion, looks good. It hasn't adjusted. It's been adjusted pretty healthily in a healthy manner. It's adjusted upwards, right? And look at your MACD cross on the weekly, right? So same type of ideology, right? MACD cross on the weekly is going to produce X amount of volume, X amount of price action, X amount of, whatever, right? So if you're holding your long position and you're in the weekly, what are you thinking? You're thinking, oh, no, I might have a little bit more to go here, right? My stochastic isn't really topped out. I'm not seeing the beveling action on my MACD in terms of price and sellers. And my RSI is not really in an overbought state. You following along? And you take all this into consideration. Is everybody with me? DJ, are you here at least?
Yes, I am.
So
I'm just listening.
The daily going into the weekly, right? Now you go into the monthly. You're thinking to yourself, okay, I know what the daily looks like. I know what the weekly looks like. Now, just based off of what the daily looks like and what the weekly looks like, you should kind of have an idea of what the monthly looks like, right? The monthly is no more than an extension of the weekly chart in a 4-time aspect, right? 4 weeks equals 1 month. So now instead of having one candle in the sense of a weekly candle equaling 7 days and a monthly candle equaling 4 weeks, now we're at a monthly candle. It equals 4 weeks. It equals 28 days, typically 28 days, but sometimes 30 days, 31 days, whatever it is. You assign these candles value, right? So look on the monthly here. The monthly for Tesla tells me something completely different, right? Look at my stochastic on my Tesla here on my monthly. My stochastic is telling me, dude, the party is just getting started, right? And if we continue to push upwards, in other words, if we continue to push another green candle here, just using logic and pushing forward, if this next monthly candle is green for Tesla, what's going to happen in terms of our MACD? We're going to get the cross in the MACD, right? So if we're able to print another green candle here on Tesla, AKA our MACD, our blue signal line will come above our buy line. We'll get a buy signal on our MACD. That would happen, right? Another green candle, MACD comes up. So that's kind of what I the ideology behind seeing the future, right? Because I'm projecting, right? It's just as likely that we print a red candle here and my MACD diverges, right? We go to break over the signal line and you diverge. But the chances of that happening when your stochastic is bottom and your RSI isn't overbought is less, right? If my stochastic was in my 50 to 75% quartile and we're coming up, right? We're coming up with my MACD curling up as well, right? The chances of you topping out and diverging on your MACD and diverging away from price is much more likely, right? Because if you think about it, 2 or 3 more weeks, your stochastic will top out. Then you'll lose essentially all that momentum that you're trying to build up, you're trying to push the price forward to higher, higher, higher. You're going to lose a lot of that, right? So now you're thinking to yourself, okay, I know what's happening on the monthly. I got the big picture, right? It was a small rip in terms of the big picture, in terms of what it could do. In the weekly, I got an idea. You know, it's a relatively good rip in comparison to what it could do. And like I said, like the daily, it's the same thing. You know, it's a good rip on the daily for in comparison to the weekly rip. You know, like these are all things that I'm measuring. I take into consideration, right? And like I said, this is what comes down to the adjustment of the indicators. You can see right now that your daily is adjusting down like a champion, right? You go from 80 RSI, let's say 80 RSI is at $375, right? Now you're at 70 RSI and you're only at 362. So in my mind, I'm going, okay, $13, 10 points of my RSI. So if we were to go down another, hypothetically speaking, this is all hypothetical, right? So I'm just trying to draw conclusions. If we go down another 26 bucks, okay, we go down another 26 bucks, another 2 extensions down on my RSI would be at what? 60 hypothetically, or I would be at 50 hypothetically, right? 10 points per $13, right? Which is, if you look at my RSI, which was typically or hypothetically where I think I would find support on my RSI, right? So in mine, I'm thinking, okay, hypothetically speaking, if I got 2 more extensions down, just like I did that, and the indicator adjusts down the same way, my stochastic would be maybe around 25, right? It'd just be entering my lower quartile, right? My MACD would, if it's not crossed by then, if it's not crossed downwards by then, it would be about to, right? Another 2 more candles. And then, likewise, my RSI, if it's adjusted down to 50, right? So fast forward in your mind. Say, pretend like you already know what's going to happen in the next 2 days. Just tell yourself. Say, I know what's going to happen in the next 2 days. We're going to get 2 more green candles on Tesla. So then in your mind, throw up 2 more green candles in the daily chart, right? If we were to do that, just throw up 2 more daily candles on the chart right now. What would happen on our daily chart, right? You'd have to see some type of also not really a divergence, but your MACD would continuously curl up. Your MACD would curl upwards, right? It wouldn't be looking to taper. It would be looking to move higher. And maybe you'd see some type of like a divergence on your stochastic, where your stochastic would curl off this 75% median and indicating to you that the price is going to push higher, right? Which is what 2 green candles would mean, right? And same thing with my RSI, right? Another 2 green candles, I'm thinking 1 green candle back up to 275 to bring me back to 80 RSI, and then another green candle, similar extension, another $13, another 10 points up to 90, right? So in my head, I'm thinking, okay, hypothetically speaking, 288 will put me at 90 RSI, right? This was hypothetical. $388, I'd be at 90 RSI. And like I said, you're trying to you create all of these examples in your mind, right? That's a green example. That's if Tesla were to get 2 more green candles on this daily. Then I go into I go through all of these options. What if 2 red candles were to happen, right? So I think to myself, what are the chances of 2 red candles happening on the daily, given what we're looking at here, right? I'd say fairly likely, right? Given our stochastic, the way that the MACD is tapering, and the way that the daily RSI is turning down. So for me, personally, on just an opinionated level, it's much more likely to me that we depreciate in terms of Tesla for the next 3 or 4 days, right? What I'm looking at is if this were to happen, if we were to depreciate for the next 3 or 4 days, I know what would happen, right? My MACD would cross down, my stochastic would fly to the floor, and my RSI hypothetically would be sitting on my RSI support around 50, right? So in my mind, like I said, I'm creating these possibilities. I'm just thinking about them. This is what would happen. This is what it would look like. This is what it would, this is what it would be. And then I go into the next time frame in the weekly. What's the likelihood that the weekly, right? We're on a 4 weekly, 5 green weekly candles here. What is the likelihood that my next weekly candle is green, right? And in my opinion, giving all of my indicators and how I know them, it's unlikely. I mean, it's likely that my next candle is green, right? Because we come off the MACD, we get that nice, good, healthy buying pressure, and our stochastic turns up, RSI turns up, everything turns up, acting healthily, but it's not topped out, right? So we could get, in my eyes, we could get another week of bullishness in terms of Tesla, another 3, 4, 5, 6 green candles of bullishness, right? In order for the weekly to top out, right? And then the same thing with the monthly. I'm thinking about the monthly. I'm saying, well, the monthly can afford much more than that. You know what I mean? The monthly is going to take maybe 5, 6, 7, 8, 9. Maybe, it really depends how many weeks it will take for my monthly to top out, right? And like I said, what I'm always measuring is the deviation between how these time frames and the indicators are adjusting towards or away from how another time frame, a bigger or smaller, in relation to each other, how they're adjusting, right? In this lies the truth, right? In this lies the truth. And that's like what, big thing to consider here. And if you're looking at the monthly, you see that we come down and we double test the 100. That's why we get that big pop, right? Great big pop off the 200 there. So there's really not much here that tells me that Tesla is bearish. In terms of the long term, right? In terms of weekly, monthly, that kind of sense. In the daily, it doesn't mean that we can't see another 2-3 days worth of bearishness. But within the 2-3 days worth of bearishness, my daily would have reset. My monthly, my weekly would have tapered slightly. Probably not, to be honest with you, because we're going to get 3 or 4 days of bearishness on Tesla, and then it's probably going to rip through the fucking skies again, right? Because the weekly and the monthly still have more room to move up. But if you're playing, for instance, like a short-term swing, like a 3 or 4 day swing, yeah, a bearish swing on Tesla here, right? As the daily tops out. But if you don't get out of that Tesla swing long before, in other words, you're playing a Tesla swing, right? You want to long it. You're playing a Tesla. You want to short Tesla, right? If you don't cover that short within 3 or 4 days, while your 1 day is bottoming out, right? Fast forward 3 or 4 days, your short hypothetically is successful. The 1 day has adjusted down, right? If you're not out by the time the daily turns back up, guess what? Now you're trading. Now you're trading the weekly, and now you're short on a weekly explosion, right? On a weekly ramp that literally just relieved 3 or 4 days of selling pressure, and now is going to continue upwards. Do you guys see how important multi-time frame analysis is? This is very easy. I'm using a daily, a weekly, and a monthly. This is like as simple as it can get. You know where it gets hard? When you're trying to measure a minute, 5 minute, and a 15 minute. Because you could spend the next 2, 3, 4, 5, 6, 7, 8, 9 days, right, evaluating a monthly chart or a weekly chart, and maybe not miss that much of a move. But if you're spending a good amount of time measuring, Frank says I got to measure the 1 minute indicators, 5 minute indicators, you're going to be spending all that time doing all that work and not placing trades, right? That's what I'm saying. You need to build up the fundamentals, the foundation, being able to do this instantaneously, so that as you're flipping through the 1 minute, the 5 minute, the 15, the calculations, you can do them if you want to, right? But you already know you already know the conclusive data, which is that's all you care about, right? So to give it a more direct example, when I see my 5 minute is topping out, right? When I see my 5 minute is topping, I automatically, right? I go to my 1 minute, right? Because if my 1 minute and my 5 minute are topping, right, at the same time, and then my 1 minute looks to adjust downwards, right? So my 1 minute is coming down. I get 4 or 5 minutes of bearishness, right, from my 1 minute to bottom. This is another thing that it's a very strongly, in my own opinion, but in my own personal experience, if indicators are adjusting down more promptly within 2 or 3, for instance, a bottoming action on a minute chart could take anywhere between 2, 3, 4, 5, 6, 7, 8, 9 candles for it to occur, right? In which time it occurs, if it takes 2 or 3 candles, or 4 or 5 candles, or 6 or 7 candles, or 8 or 9 candles, tells you how bullish or bearish the price is acting based upon the indicator's adjustment, right? If my indicators adjust down on my minute in 2 minutes, which is as quickly as I've ever experienced it adjust down, 1 minute down 50% stochastic, 2 minutes down 0% stochastic, fully reloaded, ready to go. If it does that in 2 minutes, your stock is bullish as all shit, right? If it takes 9 minutes, 9 candles for it to adjust down, that's a lot of bearishness. That's a lot of extended bearishness. Why would it take me 9 fucking minute candles to adjust up a stock that's going to move back upwards? Why would it take 9 candles to do that, right? I would much rather take 2 or 3 candles, right? So like I'm saying, in the minute, if I'm looking at my 5 minute and my minute is topped out, I'm thinking in my head, okay, my minute is topped out and my 5 is topped out. The chances of bearishness being here in the immediate aspect is high, right? My 5 minute and my 1 minute is topped out. But if my 1 minute bottoms in 2 or 3 minutes, guess what? The 5 minute, the chances of the 5 minute diverging, in other words, if my stochastic is heading down due to my 3 or 4 minutes of bearishness on my 1 minute, right? My stochastic and my RSI and MACD is all curling down. If my 1 minute resets quickly, the chances of you seeing a divergence, in other words, a divergence between the minute and the 5 minute, right? If your 1 minute is adjusting down quickly and now your 5 minute has come down a little bit, but now your 1 minute is bonded and it's going to turn back up. What's happening on your 5 minute? A divergence, right? A divergence from what you thought, what you believed that the 5 minute was topping out. Now the 1 minute showed you that it was topping out, but it bottomed out even quicker, and now it's going to push higher, right? And it's the same thing. The 5 minute to the 15, the 15 minute to the 30, the 30 to an hour, right? If I want to know what's happening on the 5 minute in the next 3 candles, if I want to know what's going to happen in the 5 minute in the next 3 candles, what am I checking? Checking the 1 minute, right, to see where I'm at now, to get the given sentiment in the immediate sense. And then I'm looking at the 15 minute to say, okay, if I were to print 3 green candles on my 5 minute, that would give me 1 big green candle here on my 15. What is the likelihood of this happening? Yay or nay? And that's how I base my trades. Always, 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 always. Always base my trade on this.
Yeah, and you bring up a good point. Like, always, you have to do this. Like, remember, guys, everything ties in together. You know, day trading is really tough. Like Frank said, like, it's not something that you can just do right off the bat. It's a lot easier doing the top-down approach, right? Start with investing, put majority of your money into investments, and then see how they play out, and then slowly go into swing trades, and then slowly go into the day trades where you have to react faster. A lot of things can change within a matter of 15-20 minutes, right? And I think that would help you guys, especially if you're just like getting into the trading and you're like, okay, I want to day trade forever. If that's what your goal is, really start from, looking within, looking at, if your goal is to do this for a living, you have to be able to do it really fast, and you have to be able to execute these trades without a moments of like hesitation, right? And if you're new, it's going to be hard to build that skill, because when the stock's moving up, the first thing we're going to be doing is selling, right? I mean, that's the normal reaction. If the stock's moving down, we're panicking. We're like, okay, we don't want to take this loss. And this is what happens to most new traders. They're like, okay, I don't want to take a loss. Maybe it's going to recover, because the last time that you took the same kind of trade and you took a loss, the stock bounced right back up and it came back to your entry. So then the next time you're assuming that it's going to do the same thing. And again, these trades aren't the same. No two trades are ever the same. So you're going to end up losing money on the second one again, right? And slowly you'll understand that, hey, you know what? The problem isn't that, okay, yes, partially, majority of it is you weren't trading with a strategy, but the other part of it is that you were not trading at a time frame that you're comfortable in. So, scale it back. I know, like if you guys want, trade SPY. SPY is so easy to trade every day. Now with Robinhood, you guys can do option trades for free, I think, right? And try and use the 5 minute or 15 minute on SPY and see the overall direction, and then try and scalp a little bit of that, right? And then move on to these trickier stocks that are momentum plays where we have so much volatility. I want you guys to do 2 things as homework today. I want you guys to look at a chart and tell me when there is greed, and highlight the greed, highlight it in green. And then I want you to highlight the areas where there was fear in that chart, right? And I want you to see it visually, like make a box, right? Like D2 and Frank, you've been doing. Like, I want you guys to see where the fear and greed is on the stock. And if you can see that in a chart, you're halfway there. You're good on your technical analysis, and you can really attempt to do a better strategy and make more money. Now, the next question I did have, Timmy had, was the difference between the price and the indicator. So we've covered this. It's called divergence. If you actually look on our YouTube channel, Superbloom did a nice lesson on divergence and the divergence between the price and the indicator. It's very important to learn this. Trust me, it's one of the tools that me and Frank and most of our team, we can just look at the indicator, look at the price, and we're like, okay, we know there's a divergence. We know there's something hidden, and unless it breaks divergence on the indicator, we're not going to get in. And this all ties in with your entries, right? So I'm just going to post this picture real quick. What you guys need to learn, and if you guys are new to our group, most of this material has been covered in depth before. So right now, I'm not going to cover the same material again, but I'm just going to give you some resources that you guys should look over and really study. Honestly, print it out, paste it on your wall, and keep it there, and try and understand where your entry and exits would be, and why we are entering or exiting at that point. Like, it's more than knowing where to get in and out. You want to know why we're doing it. Why are we touching this ticker? Why are we not touching this ticker? What are we waiting for to happen, right? And that's what's going to make you guys consistent traders, and more importantly, independent traders, right? You don't want to be following calls. It's not how you can make trades consistently. What if we die, right? You really want to build that skill for yourself. These pictures, I think, will depict everything that you really need to know about the pattern side, right? But the pattern is just one side of the equation, guys. You know, Ziggy did a really good lesson on tape readings that I recommend everyone go through. I just posted the link over there. And though that tape reading one, it's so extensive, okay? Like, take the time, go over it, and he has highlighted everything you need to look for. Once you know what to look for, then you can start looking for it in these trades. And soon you'll see correlations between what you learned and what you actually see, and you'll make your own hypothesis on what's going on, right? Now, reversals are hard, right? Why does a stock reverse? Is it overextended? So, Opti, you can bring up a good question. It's never easy to find reversals. You know, knife catching is not something that everyone's good at, and it's not something people are comfortable at. That's only one strategy that you can incorporate. That's not the only strategy that you can trade, right? Now, when you're looking at reversals, we're looking at a rejection of a resistance level, and or rejection of a support level, and it just tanks, right? It tanks, goes lower, goes lower, goes lower. Where do you think that stock is going to find that support? If you think it's at VWAP, if that's the indicator that you follow, okay, at VWAP, I'm going to take 20% size on this ticker. If it starts moving up in my favor, I'm going to add the other 80%, right? Or let's say it's a 200 moving average. Or let's say you're looking at the chart, and let's use CLBS as an example since we see it here. We know $8 is support. We know that if it breaks 8, this can go to 6, right? So at 6, what are we going to do? We're going to go in for a long position. We're going to short it until 6, go in for a long after 6, right? Now, what's the next question? It's really hard to on reversals. You want to see other buyers that are seeing the same thing. Remember, indicators are only as good as the amount of people that are using it, right? The same settings, the same criteria, right? And if we're technical traders, we are technically trading against retail traders. You know, like they're the ones that are doing these day trades and trying to make scalps like we are, right? So you have to understand the crowd that you're trading. If you're trading MU today, okay, obviously it has earnings coming up. It has upcoming earnings. Does it follow? Did it follow any technicals? No, the thing gapped up to $61, came back down to 59, tried to stabilize at 59. People are like, oh yeah, we'll hold it for earnings, and then tanked down, right? As soon as the market crashed, right? So, sorry, not the market crash, when the stock crashed on ER. Reverse right back up. This isn't a technical play. This is a play on earnings, right? Know the people that are trading these. Every dip, they're probably buying it, right? And we see, look where MU tanked to. It tanked to 57.50s, which if you look in the last 3 days, it's the same level that MU tried to maintain support, right? So we know that's a good buy at that area. We're going to buy it over there, and we're going to, where are we going to sell it? We're going to sell it at the 61, because today morning we tried to take out the 61 and we couldn't. And that's a clear trade right there, right? But how do we get into a trade like that? Well, you have to justify the entry by looking at the tape, looking at the level 2. Are buyers stepping up? Is the selling pressure decreasing? That's something that you guys will learn over time. And honestly, the only way to do it is screen time. You guys have to put in the time and effort to go through these tickers that we're calling out. And we don't want you to take the trades. No, never blindly take anyone's trades, ever. What we want is you guys to look at the trade, follow through with it, look at the tape, look at the level 2, and see what works, see what's going on, see how it reacts, and see the outcome of that trade, right? And you'll learn more from just watching us and seeing how we're getting in and out, and why we got in, why we got out. That's probably the easiest way to learn. The easiest way to learn trading is in real time, right? It's hard for us to explain these tickers to you throughout the afternoon, because we don't even know what the tape looks like. We don't remember. We're looking at so many tickers. Remembering one specific moment on a ticker, especially on the tape, is going to be really difficult, right? But if you guys are following along with our trades, you guys can see how it's developing, right? Or breaking down.
Yeah, like with my trade today, there's so much value in that. So much value. Literally,
And that is the value, right? That is the biggest value we can give you guys, okay? These lessons, anyone can teach you the basics, okay? But creating your own strategy, no one can teach you that because we're not you. We don't have the same emotional reaction to things. Our risk tolerance is different. Our projections on what we have to make on a daily basis or weekly basis are different. So for us to, it's not a one size fits all solution. But if you take all of the data that you're getting from us, you can judge, hey, you know what? Maybe I should follow Redbend because he's trading the 15-minute and it's more slower pace, and I like that pace. I'm more comfortable trading there. I have more time to make decisions. Or if you're like Johnny, where it's like, hey, I want to get in and get out on a ticker quick. I just want that little quick burst of price action, and then I'm going to quickly grab my profits. It depends on your strategy and how you are as an individual. Are you fast at that decision making process? And again, the top down process works. Start with the larger cap tickers that don't move as much, and work your way down, because the lower tickers, right? You're trading $1 ticker and it goes down 50 cents. It hurts. But you're trading $100 ticker, it goes down 50 cents. You're not going to be crying about it, right? Yeah, and differentiate from a pullback. So a pullback would mean that it's still on a strong upward trend, right? It's not breaking major support levels. Buyers are coming in on that pullback. So when we're looking at pullbacks, let's look at a stock that we traded. Oh, what was the ticker today? NACD, right? Not NACD. What was the last one?
NACD had some good pullbacks on the 102.
Oh, NEPT. I think NEPT was a good one. Let me check. I want something clean. Actually, NEPT is pretty clean. Like, if you look at what happened in the afternoon session, right? You see that we broke out. We broke out of a nice little consolidation period that we had, right? We reclaimed the VWAP. Now what? We reclaimed the VWAP. What are we going to do? We're in the trade. And maybe we only took a small size. We want to add on to this trade because, hey, we're breaking these resistance level. We broke over the 390s. We're hitting 4, and at 4 we found some resistance. And look what happens when we hit 4, right? The stock goes down, tests that 50 moving average, and moves right back up. So that 50 moving average would have been the nicest entry, right? With a stop loss maybe at the 100. Now, these are like hypotheticals, guys, okay? Not like definitive answers on when you should enter pullbacks, right? But look at the overall trend. The trend is moving up. We see volume increasing, and on the pullbacks, we see that the pullbacks are on low volume, right? Like, those pullbacks are low volume, and as soon as buyers start stepping up, we know that, hey, we're in a good trade, right? It starts moving up. It moves up again. It gets overextended at 415-ish. And look at that drastic candlestick down. Now, that was the first indication that, hey, maybe this won't move, right? So what do? You would probably get stopped out if it breaks that 20 moving average, thinking that it might go all the way down to 4, right? So why take the 5-cent risk, right? Now, in this case, you probably would have stayed in the trade. You probably would have got, if you have a tight stop loss, it really depends. You might have got stopped out, and most retail traders would have got out on that dip because that's on pretty large volume compared to the rest of the move. But the next minute, you see that the volume isn't increasing, but it just spikes up. What is that telling you? That's telling you that buyers are there and there's no sellers. If there were sellers, they'd be keeping the stock price down. But within a minute, that stock moved up another 5 cents, and then it found support and it continued to rip up, right? So really hard to judge a pullbacks on this one. Now, let's go to GVO. GVO is an easy one. Now, this is where a pullback failed, where we know it's not a pullback. It's open in the morning. We had that huge spike up, right? Not a huge spike, but a relative spike up. Because, as soon as the market opens, everyone's going to be taking profits or cutting their losses quick, right? And all that selling pressure came in, and that was the largest volume all day. But then buyers stepped up. They tried to break 918, and they couldn't. So now the stock goes back down to 16 range. We're thinking, hey, this is a pullback entry. Maybe this will actually go up, right? And that's why you see that movement on GVO. That's why you see that, hey, it went to 16, jumped back up to 1650, went back down to 16 range or 1560 range just to test the support. It held support, and what happens after that? more buyers step up, more buyers came in. But again, the selling pressure was too great. At 1650s, everyone was starting to sell, and overall, you know, the trend just broke down from there, right? And it's hard to tell. You really don't know. We don't know what the future of the stock's gonna hold, right? We use our technical analysis skills, and we use something called a stop loss, right? If we're wrong, it's okay. We're gonna get stopped out of one trade, and that's one thing that I think everyone needs to focus on, is that this in this industry, we're not here to predict what's gonna happen. We have a general idea of what happened. We have a general idea of how it's happening and why it's happening, and so we're assuming that it's going to continue in the direction that we're, you know, hoping, right? In this case, Jivo, we were, let's say we were bullish on it. We're assuming that it'll go up. The moment it comes and cracks down from that support range, what do? You get stopped out. That's just a bad trade. You can go on the reverse and then be like, okay, now I noticed something. I noticed that it couldn't pass the 50 moving average. So next time it gets near the 50 moving average, I'll just short it, right? And the short side, Jivo tested that 50 moving average. My friend actually that's trading with me beside me, he literally, I was like, hey, just short it every time it hits the 50. And every time he hits the 50, he started shorting that thing, right? And that's another technique you can use. So yeah, there's so many ways around it, and each ticker is different. So really got to analyze it for yourself and see what works.
Can I add some stuff in there, Dante?
Yeah, go ahead. I'm gonna go for a quick break for like 5 minutes, but you can go ahead, take it away.
Yeah, so I mean, everybody knows how I measure. I call, like, for me, it always comes down to measurements, right? Because if you're trying to measure a pullback, right? Like TJ started off the example by saying, like, you're not gonna break, previous, your acting support, your previous support. You're not gonna break that acting support. It's a healthy pullback. You should always maintain above whatever your acting support was or is trying to be, right? That's what a healthy pullback would entail at the stock. Especially if we're talking about a stock that's appreciating, obviously, your pullback is going to be towards support. Yeah, so let's look at, I like this top picture here. Look at this top picture here for IQ that's a deck using. So look at this IQ chart. Like, this IQ chart, to me, well, I really like how it shows, like, the numbers, because it saves me a lot of math, right? And it saves, I'm sure, him a lot of time, right? Because he doesn't necessarily have to measure to calculate the extensions. The numbers are right there for him. So in this example, look at our consolidation there, right? $34 consolidation, right? You see, and one thing to notice here, like, kind of hard to see with all the numbers, but you can see how the channeling and the coiling there on that $34, $35 mark is tightening, right? Start off pretty loose there, get a lot of loose consolidation, and then it really tightens up, starts to move upwards, gets squeezed downwards, right? Which is the dip before the rip, and then now we start the rip up, right? So you could sift, like, after you're coming out of, long of the consolidation, right? You have a lot of support there, right? A lot of people bought and sold at these prices. So, like I said, in terms of elasticity, like, I always like to use this word, but elasticity, the closer you are to that line there, the less elastic, you should be, right? The higher you move up, the more elastic you're going to be. It's like a pull away thing, right? Where it increases as you go further away. And they call this, like, it's basically mean reversion. It's the same thing. And the way that I look at it, if you use VWAP, a lot of people use VWAP. I typically don't use VWAP that much. And the reason being is because VWAP is only telling me a lot of information that I already know. Like, I look at volume, I look at the consolidation, and I have a pretty good idea of where this price deserves to be. That's basically what I call the VWAP. But if you use VWAP, right, and you're thinking of your VWAP, and then VWAP is, like you said, the volume weighted move average price, right? Like, it's where most of the volume is in terms of consolidation. It's where most of the volume lies within that price, like that average price there. That's where most of the consolidation, or most of your buys and sells lie within this price. That's why it's very common that it bounces up and off this price, because if you're looking at it in terms, you're always trading speculative. Stocks are speculative, right? The prices of stocks are all entirely speculative. Nothing about Apple. Nothing that makes Apple worth $1 trillion, for instance, has to do with the value of their shares, right? The value of their shares fluctuates as well as their market cap, but it's not like one share of Apple equals so many dollars in terms of Apple's worth, right? It's a speculative thing, right? It could be in an example. You could have a stock that's at $100 a share, right? That's a speculative value, right? Where people are buying and selling currently, but the real value, the true value, well, fundamentals, they call it true value, where the stock really should be fundamentally is like $50, right? So that's the same thing. And in my mind, VWAP is the $50, and if you're at $100, it's extremely elastic, right? The further you are away from VWAP in either direction, upwards or downwards, the more elastic you're going to be. And like I said, the more likely, the further you move in either direction, the likelihood of you returning to mean reversion, or the way that I look at it, like I look at it with my own type of like twist, right? Going back up to that guaranteed, the deserving price where you last confirmed that the price deserved to be here, you got to retest that, right? That's the mean reversion, going back to that, guaranteed price. So looking at this consolidation, right? You see it tightens, and now it's pushing. You see it tightens, it's healthy consolidation. You're not breaking 34, 31 mark, right? The entire time you're holding above that line, and you're pushing upwards, right? We're increasing. We're going from 34.78, 34.84, 34.92, 34.97, 35.2. You see how that's increasing, and then on the other aspect, it's not. It's you're still holding that bottom line there. You're holding. So as your resistance is increasing, right? So resistance is rising, essentially going up, right? Becoming further away from that mean price there of 30, whatever you want to call it, 31 flat, right? Pushing upwards. So that should be an indicator to you that the path of upwards, right? So then it breaks out, right? You get this formation, consolidation, right? This accumulation, and then it breaks out, right? I'm repeating myself over and over and over and over and over and over and over again, right? Look at the extension, how much extension you get, and then look at your pullback. 38.7, 37.37, right? $1.43. Same thing, right? Extend up, look at your pullback. Look at the pullback. 39.74, 38.05, $1.74, right? So right there you're saying, okay, this pulled back harder than it did last time, and I got a shorter extension. So this tells me that we need some type of, the price is getting to the point where it's undeserving, right? We need some type of consolidation here, right? If we're going to push this price up higher, which we're clearly going to do, another $3 or $4, right? We're going to see more. I expect to see sellers. I expect to see people coming in to bring this price back down to create this type of area. And I'm going to call it like where you see this gray area, these two gray boxes, the black box, and then the next two gray boxes, like this sandwich, this Oreo formation here, if you want to call it that, opposite Oreo, like this consolidation and depreciation needed to happen, right? It needed to in order to make the next step upwards. This part right here is vital, right? And let's talk about pullbacks. You want to talk about pullbacks? This is a phenomenal example, okay? So you're appreciating, stock is bullish, you're appreciating, price is appreciating because of it. You're at $41.51, right? Moving up, okay? Like I said, pullbacks were heavy. You had sellers there. You pulled back $1.73. You pulled back $1.43. Now you're pulling back $1.70. So you know there's sellers here. You know they're coming. You know that people are looking to sell this shit. You know that you don't have a bunch of people looking in here. Your base isn't rising, right? If your base was rising, you would have shedded $1.43, and then you would have shedded $1.23, right? If your base was rising, if your support was rising. So you're questioning the integrity of this stock. So I'm here at 41.50. I'm extremely skeptical of this position. And I'm saying to myself, I should probably question the long here, right? And the amount I should question this long here, now we have hindsight. I'm speaking now from the hindsight because we know what happens. This value, the value of this from 41.51, it took all the way down to 37.57. That's the value of what I'm feeling right now. Like I didn't know that when I'm thinking that, right? I suspect that we need to pull back, right? I'm saying, oh my God, we got to pull back. This thing's going to rip up. We're going to pull back. We got to consolidate lower, right? And in my eyes, 37.57 is a good key, right? And what I'm using as my acting support, you know what if I'm looking at this stock, I'm not saying I would have held my long, like TJ's saying, if you're not taking some off at these overextensions like 41.51, I would have taken 50% of my position off, probably even more, to be honest with you. Because at 39.74, I'm already questioning my position. I'm already saying, oh my God, I should take some off. I probably already have, to be honest with you, 25 to 50% of my position. At 41.51, I'm selling another 25% or another 50%. I'm lightening my load because I know the move that I just got. I'm not stupid, right? I'm looking at my account. I'm happy. I'm saying, yay, I made a bunch of money. Not by switching to Geico, right? So I know what's happening. I can see it. I can touch it. I can feel it. And if you leave that money there, this is why I call it the taking advantage effect. If I left my gains there, sitting at 41.51, somebody's going to look to eat, right? Shorts are hungry, right? People are looking to sell. People are looking to take profits. Shorts are hungry. Everybody's hungry. The stock's been on a grind, right? So all this depreciation down. Now you see this you see how we bottomed down there at 39.4? How we hit that 39.4 and then bounce off of it? That is a good signal for me, right? The fact that this happens, like I said, there's different formations that say different types of things. The fact that the bulls came in here at 39.4 and looked to push up the price all the way up to 42.13, and the fact that they were able to get above the resistance of 41.51, right, my previous extension, I'm stoked. I'm saying, wow, baby, that's sweet, right? That goes to show me that people are still bullish on this stock. You can take profits, you can look to short it, and you can do whatever you want, but people are still bullish on this stock, right? So I see this rip back up to 42.13, and granted, my buy, so if I sold at 41, let's say I exited my entire position at 41.51. I have can somebody hear me? Make sure you can hear me.
Yep, I can hear you.
Yeah.
So I don't care about this stock at all. I exit my position 41.51. I'm a happy goose, right? Now people are saying, Frank, how do you know when to re-enter, right? So I'm sitting at 41.51. I sell my position. Which means I think it's going down, right? If I didn't think it was going down, I wouldn't be selling my position, right? And like I said, it's a scaling thing, right? At 25%, when I was at 39.74, I'm questioning. I'm saying, oh, the stock price could go down from here, which is represented by me scaling out my position, right? Securing gains, lightening my load, right? Because I know that I'm suspecting of depreciation. After I saw that dip, that second extension was greater, I know that sellers are here. I know that sellers are going to look to take advantage of these gains, and I don't blame them. We ripped from $34 to fucking $41 in, what is that, a matter of a couple minutes? What is this, the 5-minute chart that I'm using? I don't even know. Yeah, the 5-minute. So that's probably like 50 candles, 250 minutes. You're talking about 4 hours of appreciation, dude. You're talking 20% on a large ticker like this, IQ, right? Relatively high float. It's not a low float. It's not, it's not a low cap. It's a relatively big ticker, and it's moving up 20% in 4 hours. Something's going on here, right? Something big is going on, right? And I see this in the price action. That's why I'm getting this type of volatility, this type of beta, right? So 41.51, if I exit my entire position, I don't care, and I don't care about the stock, right? If I didn't enter short as well. The ideology behind it, I typically would enter short here. I'd probably start my short position. This is where I'd start my short position. If I exit long, right, I sell the remainder of my long, and then I say, shit, I'm probably going to buy 25 to 50% of my short position somewhere around this price, right? Because this is acting resistance now, right? If I sell here and we don't break out, this is acting resistance. Now, mind you, if I'm holding 25 to 20, let's say, I'm going to say 25%, give myself the benefit of the doubt because I'm so freaking good. No, I'm just kidding. But let's say, for example, I get 25% of my short. I see this dip down to 40.63, right? My next red line. I'm saying, wow, this stock price could be healthy. That's a nice little pullback there, right? Good retracement of my extension there. That's good. That's healthy, right? We're down to what was that, 90 cents there? So I'm saying, oh, that's nice. And then it goes up to 42, right? Like I said, breaking now. This is like it's almost like I don't know how to explain it, but it's almost like a decoil, right? Like it's coiling in the other direction. Like you can kind of see how it widens. It begins to get wider and wider and wider, right? And then it squeezes. It snaps shut, right? And I call this is the same thing as similar to coiling. It's a reality check, right? Because it's like we're testing highs, testing lows, testing highs, testing lows, testing highs, testing lows, testing highs, testing lows, testing new highs, testing new lows, right? But you see how we catch above our acting support. If you're like me, I'm looking at consolidation. I'm saying 37.37. We better not break below 37.37, right? Because I'm happy. We're going up. We're testing new highs. If I was bullish, right? I'm saying, wow, we're going up to this new highs. Wow, we're going up to this new highs. But in the same aspect, if I'm bearish, I'm saying, yeah, this is good. We're going to test these lower supports. This is good, right? So in my mind, but this is what I'm saying. Like this is how you need to be able to change your mind, right? Because at 41.51, I'm saying, oh, this is bearish. Then I see these new highs coming. I'm saying, okay, it might not be as bearish as I thought, right? Which is a fancy way of saying, oh, it's probably still a little bit bullish, right? Depending on which way you're looking at it. So at 42, I'm going up to the resistance. Now higher, I'm getting squeezed on my 25% short position. I'm down 50 cents. And now at 42, you know what I'm thinking? I'm thinking 42, right? New high. Good job, bulls. Great job. I like to see that the bulls are still here to play. That's good. And I'm thinking to myself, there's going to be psychological resistance. There's got to be some type of resistance up here. And I bet you that's what they saw, right? somebody had a big order, 42 hits a psychological resistance, and they shorted back down. So I would have grabbed another 25% of my short somewhere between 41.51 and 42. I didn't grab my entire short 100% at 41.51 because I'm shorting bullish stock. You know what I'm saying? Like, that would be stupid. That would be absolutely foolish to do something like that. Why would you short a stock that just ripped up 20%, all at once? That's why the scaling and position sizing is so freaking important, because it's how you take control of your trade. So like I said, I'm adding another 25% of my position somewhere between 41.51 and 42, right? Averaging up. Now I see this new low coming in, right? I say, oh, we hit 40.63. I'm thinking if they're going to buy this up, they're going to bounce it off 40.63 again, right? If the stock was bullish, and they're going to squeeze me even more. They didn't. They let it go lower. So now I'm thinking in my head, okay, they're trying to play games here, right? They're trying to play games. They're going up to make new highs, testing highs, and now they're doing this like downward, going in and down to test supports, right? Which tells me that the buyers are losing steam and the sellers are looking to take over. But when the sellers look to take over too much or too far in one direction, the buyers are still there waiting to buy it up, right? It's kind of like that, like teeter-tottering, like push and pull of the ocean, if you will, right? So I'm looking at this. I'm saying, oh, okay, I got what you're doing. I see what's going on, right? I'm thinking that in terms of my short position, right? I'm short. If you want to think about it like this, I'm short bias right now, right? So I'm worried about getting squeezed, right? So now it comes back up, and right now I'm holding 50% of my short position. I'm saying, oh my goodness, like this, I better be very careful here, right? Because if we go down, we confirm this, we are going to look to confirm this lower support, and now if we break back up over resistance, now it's like, okay, Frank, you average down, you're trying to take control of your position. How far do I want to take it? You know what I mean? And I can tell you right now, if this were to rip up, like on this extent, goes down to $40, and now it rips up to like $42.50, it wouldn't even be for me. It wouldn't even be like adding on to my short or anything like that. If I was crazy, I would double down, and I would look to get out immediately if that were to happen. Because that's a completely different, that's not what we're seeing here, right? Like if this were to go break out a new high, I'm thinking to myself, this thing is bullish as shit. Every time sellers look to drag this down another 40 cents, they rip it up $2.50, right? I'm looking at the pullbacks versus my extensions upwards. If you're pulling back 40 cents and then ripping me up $2, the bulls are, even though the price is going down, right? The bulls are still in control. You can say all you want, the bears are in control because the price is going down, but the bulls are still in control. You can rip the price up $2, but you can only bring down 40 cents. The path of least resistance is clearly upwards. The bulls are in control, right? So this is good. The 41.29, I'm thinking to myself, oh, this is good, right? And ideally, for me, I want to add my position. Now I'm holding 50% of my short position, right? Now I want confirmation that I was right. So if this came back up, I'm looking to add to my short position now in between 41.51 and my average, right? In between my acting, if you want to call it resistance, right? My initial buy, and then my, acting support, if because you got to inverse it because I'm shorting, would be like my average, which is now in between 41.51 and 42, the average 73, right? So I'm thinking to myself, I got to add in between there. If we break over 41.73, chances of us breaking over 42 are extremely likely, and in that case, I'm getting squeezed on my short. Now I could be loaded potentially 75% of my position, right? Which is, in my case, that's a fairly amount of shares. And if I get squeezed for $1 on 75% of the position on this type of a short, that could cost me some serious money. That's 2.5% on what is almost a full position, 75% position. So I don't want to get squeezed like that. I acknowledge my risk, right? So this 41.29 for me is like, yeah, dude, thank goodness, right? Even if I didn't get to add to my short, I don't care. I'm just happy to see this lower resistance, and I'm like, good, I'll ride the 50% that I have down to the floor, right? I'm thinking like that. I'm a short. Everybody with me still?
Yep.
So now we go down, right? And I'm looking at 40. Now I'm holding, let's say I wasn't as good. This wasn't one of my best days trading. I'm not on my zone, and I didn't get my short. I didn't add to my short. Even though we got to the low resistance, I still didn't add to my short. So I'm holding 50% of my short, and I'm going, and as we're going down, I'm eyeballing. What am I eyeballing here, guys? I'm eyeballing 40.02, right? And 39.74. I'm saying, okay, we need to break 40.02, and then we need to break through 39.74 to confirm that my short is still working, right? The short move is still here. So we go back down, and we break through, right? And we get lower. And that's where I always measure the pullbacks, right? You see we went from going down, 62 cents, and what do we go down now? Same thing, 62 cents. It's literally the same exact thing. How funny is that? Or 61 cents versus 62 cents, whatever, similar. It's very close, right? It's almost the same thing. So I'm looking at this and I'm saying, fuck, man, like these bulls are here, man. Like they're relentless as shit. But look at these sellers, man. They just continuously are pounding this, bringing this price lower. So now I have 50% of my short position. Let's say we're sitting here at 39.4, and I think my short is golden, right? I'm saying, yeah, my short's good. My short's good. I think that we're going to go down because we broke below 39.74. I think we're going to go down to 38.7, right? Lo and behold, if I was smart, right, I took some of my short position off, 50% of my 50%, right? Took a little bit off just to protect myself. I realized that we came from 41.51 to now to $39.40, which is essentially a $2 move, right? It's a pretty big move. So I could at least secure $1, $2 profits on, let's say, a quarter of my position. It's money. It's money in the bank, right? Now I'm looking at it saying, okay, now I'm saying, whoa, we had a nice pullback here, right? Now I'm thinking about it in terms of my moves, right? My previous extensions upwards. I'm saying this is the iffy zone, right? And you can understand why this is the iffy zone because between 39.74 and 37.37 lies the iffy zone, the acting consolidation. Is the consolidation or the what took place in terms of the price action and our grind upwards that took place between this range? Is it going to hold in terms of how strong this downtrend is looking, how much these sellers are coming in? Now people are looking to take profits, right? So now 39.4, like I said, if I'm smart, I took some off. If I didn't, I'm holding my full 50%, and now they're bringing me for the ride back up, right? So at 41.29, I'm looking for resistance. It wasn't there, or it was there, but they clearly broke out of it, right? So I'm a little nervous. I'm saying, okay. They're looking to squeeze my short position a little bit, right? Let's say my average is 41.73. So I'm looking at 41.29, right? My acting right there, my acting resistance with whether the price stops at, and then the 41.51. Because I'm saying, well, if they get up for 41.51, they're pretty much a short shot to 42, right? So now I'm thinking, okay, if they're going to squeeze me to 42, I will be down 27 cents. I'll be on $41, about 0.25%. I can afford that, it's not that I'm calculating my losses. I'm trying to make sure that they don't surprise me with these losses. It's about sticking to my plan, right? Because I know at 42.50, I'm down 80 cents, on a 50% position. It's going to cost me, it's pretty nice. It's not really what I want to be doing. It's a 2% loss. It's a nice little squeeze there on me. So I'm really questioning this level here of 42, this 42 resistance. And I'm saying, shit, if this thing's going to fucking break out, guess where it's going to do it? Right here, right? This is where it's going to happen. It's going to break out higher. The sellers are going to lose the battle. The bulls are going to take over, and they're going to rip this thing, right? So, like I said, depending on what kind of day I'm having, if I'm on the top of my game or not, they would have either shook me or not shook me. I would have either covered my short or I would have added to it, right? Yeah. Depending on how I was doing that day. And a lot of it depends on what I'm seeing, right? I don't see the future. I have no idea what's going to happen. I'm just looking at the chart. I'm trying to read what the chart is telling me. And now that I'm trying to explain it to you guys, I'm trying to have this unbiased opinion. I'm not trying to choke myself and saying, oh, I always buy perfectly at the top. I always buy perfectly at the bottom and I always sell perfectly at the top. It's not always the case. I have no idea what's going on, just like you. I'm sitting in my chair, looking at the chart, looking at the volume, looking at the price action, and I'm just as worried as you would be in a position or whatever. It's the same thing. I'm experiencing the same thing, right? Psychology. So,
yeah. And guys, what Frank is trying to explain is you guys got to paint a picture of what's going on in the trade while you're in it. Trade management is important. It's just as important as getting in, out, and placing a stop loss. It's part of your strategy, and you have to really focus on that. You need to know when, hey, I got into this trade looking at this, thinking that this is going to happen. But while the trade is going on, you have to manage the trade. You have to see it. Is it sticking to your plan? Is it going down like you expected it to, right? Is it going down as violently as you expected it to? Because in this case, we're shorting, right? And if it doesn't, then hey, you know what? Maybe we have to flip the switch. Maybe I should be a bull on this trade and not the bears, because clearly this should have broke down by now, and it isn't, right?
Yes, absolutely. This clearly should have broken down by. And then, I'm trying to, measuring the amount of bulls, right? The bulls keep on taking over this price. We're grinding lower. We're forming lower lows. This is why it's tricky, right? It's very tricky. It's designed to trick anybody, even me, who's a good trader. I think of myself as a good trader. It's designed to trick me, and I get fooled sometimes, absolutely fooled, right? So you always have to take it for what it is, what's coming, and you have to evaluate it. You have to constantly be, like you said, either supporting or going against your idea. Like there's only two ways that it's either black or it's either white. It's either helping you or it's either hurting you. You're either making money or you're losing money. There is no in between. You know, it's very uncommon that you're going to be like, oh, I bought a position and I have the same amount of money that I bought it to 3 weeks ago. It's like, what? That's very
Exactly.
That's coincidental. That's just like, wow, that's very strange. Like, good for you, whatever. Like, that's very strange. There's so much that can happen within that time, and you have to take what's happening within that time into consideration. Right? That's what's going to help you either, put your position, in a better position or a worse position. So this is these next two extensions in terms of pullbacks. You want to talk about pullbacks? This is a perfect example, right? Because we're so confused right now. We're saying, shit, we're going down, we're testing support levels. Shit, we're going up, we're testing resistance levels. I have no idea, right? The thing that I'm concerned about, like now, let's say we're, we're on the same page, where that, the green 4213 level is, right? We're right there, we're at the top, right? So if you're a bull, you're like, shit, this is good, right? If you're a bear, you're saying, shit, this is bad, right? But for the bulls, is this spot really any better or relatively, to the previous spot? It is to the 4129, right? Where we came back, where we came up and we saw resistance there. We broke through that, so we're saying, oh, okay, that was just like, a little lie to us, like not really, that's where you're going to see type of deviations, right? Or divergences, right? And you're saying, oh shit, that's kind of strange. And then you go back to the $42 and you're saying, well, we broke over the $42 resistance, right? So in my mind, I'm thinking to myself, I'm saying, these shorts, anybody who's shorting this, right? They're not that concerned because you're not blasting over these resistance levels. Remember I was talking about earlier today about if resistances are tighter, if your supports are tighter, like the opportunity for bulls to make money. The opportunity for bulls to make money in this type of formation is very minimal, right? The bears, but in the terms of the bears, the price continues to grind downwards. So for me, I'm not covering my short here. Like I said, it really depends on how I'm doing that day. But if I'm up, if I'm down already on the day, I probably wouldn't take too much risk here. You know what I'm saying? But if I'm up, like I typically am, honk my own horn. But I'm either going to add to my short around this level, or like I said, I'm really eyeballing a nice extension above this level to potentially short squeeze me or a position where I have to cover my short and panic sell, right? So I'm adding, like I said, to my own horn, I'm adding my short position here at 42.13, like I said, because this new high is not really, it's not really a new high, like it's not like a new high like we've been seeing. It's more of like almost like a short squeeze over the psychological, right? A little run over the psychological level there at 22 over the break of resistance. And for me, I'm thinking to myself, you're breaking over 42 psychological level that we got rejected off of really hard, right? If you scroll back to 42 there and you see that big red candle, we got rejected really hard off of 42 here, right? Where did all these sellers go, right? Were they all sold? They're all gone? So in my head, I'm thinking, wow, if they break over this 42, we better run this puppy. We didn't, right? We find resistance really close, which tells me, guess what? Sellers are still looking to take control of this price, right? It's literally what it tells me. So now, I added my short position, 25%, whatever, 50%, whatever you want to call it. And now, look where I am. Now my short average is phenomenal, by the way, right? If I get anywhere close to 42, which I probably would take 42.07, and then I'd be mindful of the squeeze, right? So I'd probably get, let's say I get 42.07, and I'm at 41.73 average. What does that give me? Hold on. 34, 26, 16. Why can't I do this math? 34, 1/3, 11.3, 70. So it would give me 41.80, about 41.85 average, right? So now I brought my average up another 12 cents essentially. My average up 41.85, and the price is going to top at 42.13. Now, talk about margin of error. Like, if like I hate once again toot my own horn. Talk about getting potentially shaken in this position because of the way that I'm scaling and I'm positioning myself. Guess how much I'm down in this position, even at 42.13? I'm down minuscule amounts. 30. What is that? 30 cents, 28 cents on $42. That's nothing. That's less than 1%. 0.75%, right? So that's why I always try to make sure and maintain that my position stays you know, within 1%. I don't want to take more than a 1% loss. If I'm taking more than a 1% loss, there's only two logical explanations. One, I was absolutely wrong in the direction, right? Or two, my scaling and position sizing was incorrect. Bingo. There's only two, right? So those are the only two options. So now I'm sitting in my short 4187, and this thing is flying to the floor. To be honest with you, on this break of 40, as we're coming down and we're breaking 40, I'm probably covering a good portion of this short. And that's because I'm not greedy, right? I'm looking at $1.85 profit, and I'm thinking to myself, holy shit, that's 4.5%. And like I said, I never risk more than 1%. So in my head, I'm thinking I didn't risk more than 1%, and I have 4.5% of gains on a cap like this, covering a good majority of my short around this $40 mark, right? So squeeze back down, right? Form this new low. Form this new low. Well, I guess it bounces in the middle there. That's weird. It doesn't show you that top, but it bounces, right? It breaks below that 40, right? And then catches resistance right there at 39.4 and then bounces back up. So I'd be very happy with my short cover. I'd be like, oh, thank goodness, right? But as you can see, now I'm looking at, if I covered up my entire short, I'm still looking at this. I'm saying, yeah, these sellers now are looking to take control of this price for sure, right? Now I'm looking for the buyers. This bounce only comes up, stays below 40.63, right? Stays below all of my support, my acting supports. It stays below all of those. If you're staying below all of your acting supports, what does that tell you? They're becoming resistances, right? My 40.63 is now resistance. So now I'm looking at this and I'm saying, yeah, I should probably short this again. The bulls didn't get anywhere on this push, and the price is going to get smashed down. Price gets smashed down, whether I shorted or not, right? Doesn't matter. But if I was good, I did. And price gets smashed down. We form this new low, right? What is that, 37.57 there at the bottom? This chart's kind of weird. Why does it show you 37.57? The chart doesn't even go down there. But we form this new low around 38, I guess 30, 38.30, 38.60, whatever that is, right? And then now I'm thinking to myself, wow, shorts really took advantage of my 41.51 position, right? If you were short, like I said, at 41.51, I was questioning the integrity of this stock. Now I'm sitting at 38.60, and I'm saying I was right to question the integrity of this stock, right? I'm down $3, right? If I stayed long, in other words. I didn't. I got a nice short. But regardless, now I'm looking, where the frick are the buyers, right? Where the frick are the buyers? Where the frick are the buyers? And like I said, these buyers, for me, if I'm trading this, these buyers they have to come in before 37.37. Because that's for me, 37.37 is the Rubicon, right? If you break below 37.37 here, then you're telling me that this entire bullish move that we just did, you're looking to negate it, right? You're looking to print a neutral move here. That's very significant. So if we break below 37.37, I am panicking the crap out of my long if I'm still holding long, which I'm not. And if we break through 37.37, you bet your ass if I don't have a short position by then, I do now, and I'll be building one continuously down. Because now my chances go back down to what? 35.2, right? The spread is huge there. And I'm not going to find much resistance. But like I said, the sellers are taking control, and now I have bag holders up top, right? So, but then that's not what happens, right? So we find support, right? And we rip back up. And this should be like, if you had any question about what this stock is going to do in the future, right? If you're sitting here and you're saying, I have no idea whether this stock is going to go up or down. This move, for me, in this black box, is a screamer. It's a screamer because it says it's the most drastic situation, right? Now I'm saying to myself, at 38.60, I'm saying sellers have taken control of this shit, and then look what happens. Buyers come in and ramp this thing to the moon, right? $13, 42.25, 42.50. We find resistance at 43. That tells me that, okay, sellers may have taken control, but like I was previously saying before, when buyers are still coming to play, buyers are still coming to play, right? So now that's what I know. Now I know it's just a matter of a game, right? Sellers are going to take control, buyers take control. But you can clearly see that the advantage here is to the bulls, right? Forming these new higher highs, right? Because we can't map these new higher highs. We don't have the rest of the chart there. We don't know that those resistances exist. All we have is the supports to go off of. So we're trying to gauge how the stock is doing based upon our supports, our acting supports, right? How low we dip versus how high we rip, right? So in my mind, I'm thinking, oh, this thing's going to rip. If I'm seeing this action, granted if I got the dip or not, but regardless, I'm thinking, oh, this thing's going to rip. Now, once I started thinking at 43, now I'm trying to explain to you the ideology. At 43.23, do you think that I'm the only one thinking to myself, saying this thing is going to rip? Do you think that I'm the only person saying that? No, absolutely not. Right? There's everybody else who's there is also saying that. Right? They're saying, yeah, this thing's going to rip, which is exactly why you get this huge sell volume and this huge pressure, because it's the perfect place to take profits. Right? When everybody is super happy, sell the greed, buy the fear, right? And then you get this consolidation, breakout over previous resistance, which we already know, right? We're looking at 38.23, breakout over, I don't know why it's marked 38 there, but 43.89, we're breaking out over previous resistance. Now it's business as usual, right? Consolidation, test up, test down. How far do we test up? How far do we test down? Same thing, more consolidation, test up, test down. How far do we test up? How far do we test down? It's literally the same thing over and over and over and over and over. So that's it with IQ.
All right, perfect. Honestly, dude, like painting that picture, I think we should do another lesson and how we paint a picture and what people will see. Like, I know for some people that just like tuned in, it's going to be hard to understand what we're talking about, but it's literally about taking control of your psychology and understanding what's going on and the thought process behind it. And that's one of the most important things, guys. You guys got to know why you're in the trade. Like, in life, justifying something is like shunned. Like, it's not something it's frowned upon, right? Like, justifying is not a good trait to have, but in trading, we have to be able to justify what we did and why we did it. And it's something that I think a lot of people lack. There's a lot of people that show me their trading journals, and I'm like, why did you take this trade? And I'm asking them, and they're just looking at it, and they're like, at some point, they don't even remember why they took the trade or why they got in or why they got stopped out. And that matters. That's the little details that's going to make you a sufficient trader later on, right?
Yeah, because think of it, guys, you have nothing to believe in, right? That guy doesn't, if that person doesn't even know why they entered the trade, then what did they believe in? Where's the confidence in that? How did you believe in something that you don't even know what it is? You know what I mean? How could you do that? You can't. You have to know what it is in order to believe in it. And like believing in it, believing in yourself and having the confidence to execute the trade is going to be the difference between, like I said, getting shaked out like a retail crash trader or being able to ride the money up and being able to make money on your money, which is what big money does.
Yeah, and I posted that little picture over there, the first thing, conserve capital. Second, generate income. Third, increase account size. You got to learn to survive first. And honestly, I think we're doing good. Our team's been on the ball lately. You got to know when to sit on your hands. As much as everyone loves to trade, it's not like we're going to get those trades every single day, So there's days you got to know. Like today was slow. We were able to talk to you guys. We were able to, talk about things that do matter, but not really trading related. But these life lessons also come in like they come all together, right? Everything is about you and your journey towards being a consistent, profitable trader. And the most important thing is like we all have different trading styles. Like if Frank has an entry, sometimes I don't take it because I don't like it, and then there's sometimes that Johnny takes an entry and I don't like it, or I'm on the other end of a trade that he's on the long side, right? That kind of stuff happens because that's what we're doing. We're trying to harbor traders that can think for themselves and really make their not having to be dependent on anyone, not any one of us. That's not what we want. But yeah, I think we did a great job on this lesson today. We have recorded a lot of sessions on our YouTube channel which go over the different the hidden divergence, because it's one thing to follow the price action on a trade, but it's another when you incorporate the indicators and you look at the momentum on that indicator. Because indicators are lagging. Most of the indicators we're using is lagging, right? So when you see that the pressure, the momentum is decreasing, but you can't see it on the chart, that's an indication that the momentum is dying. And we get those indications using these lagging indicators a lot faster than how the price starts coming down, right? So please look over those indicators. And I think I want you guys to pay attention to the RSI, you know, the MACD, the relationship to the stochastics, and try and build a system that works for you. You guys gotta, I guess, trust your indicators first, right? Now that you guys know what you're looking for when you're trading your short-term strategies behind it, I'm gonna go into more extensive, I guess, analysis on how we incorporate the tape. And the only way we can do this, guys, is in real time. It's impossible for us. Yeah, we can use on demand and we can go back on the trade and like look through it, but it's really easier to see how it plays out, because like on demand, it's kind of cheating. We already know how it's going to play out, so we can be really biased on our approach, right? But in real time, we can't be biased. We're looking at the chart, we're seeing what we're seeing, and we're trying to educate you guys on what's going on during the trade, right? So tomorrow, let's see if we get some good trades where I can teach you guys how to incorporate these other aspects in the short-term strategies. And I think we're going to close this recording down. Ziggy, do you mind messaging Jay-Z and telling him to shut the recording?
And one thing I just wanted to mention on top of that, like he says, trust your indicators. Trust your indicators because they're trying to indicate something to you. Trust but verify, right? Trust but verify. That's why I'm always drawing comparative analysis to make sure that what I'm seeing is actually what I'm seeing, right? The more statistical data that I have to support what I'm seeing, the lower my uncertainty, right? So trust but verify. Trust.
Yeah, and don't just base it off of your indicators either. Like, okay, RSI goes to 70 or let's say 80. Okay, oh, RSI is high. Does that mean we get out of our position? No, RSI can be overextended for a long period of time. Same thing if the RSI is down to like 20 or even 10. There's times that we've seen trades where RSI was down to 5, and then it still keeps going down till the RSI went to 2 or 3, right? So it's not just the indicators. You got to use everything together. And yeah, you're correct on that. Don't just use the indicators. Indicators are just a guidance, you know. I never really base my trades off of indicators. I really base them off the candlesticks and the volumes and the support and resistance level on the chart that I'm looking at. I think those are the strongest indicators for me. Then comes RSI. So I use the RSI religiously. And when I see that, you know, like, you know, the movement on a you know, whatever stock, it's moving up high, but then we see volume is good, but somehow our indicators are telling me that, hey, it's going down. The RSI is actually going down. That's something that it's hard to visually see without those indicators, right? So yeah, try and use them all together.
Yep, the more you can use together, the more accurate you'll be, always.
Yep, and let's hope we get a nice trade tomorrow. We can just go over the indicators, and you know, divergence breakouts on the indicators are sometimes like it's like a it's like a cheat code. Really, it is.
Yeah,
You'll be surprised how much times you're gonna see a correlation, and you're gonna be like, "Wow, if I had used this before, I would have been probably profitable."
Yeah, I'll definitely be on. I mean, we could definitely go over some stuff. I like to try to secure some of my own trades in the morning and secure my daily gains, and then I can just come on and help everybody else. So that's what I've been doing.
Yeah, exactly. We can't do it in the morning. Morning's way too volatile, right? We're like, yeah. And a lot of people are trading, and we got to focus on the trades. But if it's slow and we see a ticker that's, you know, running the entire day, we think it's going to run, it's a lot easier for us to, you know, really go through it and analyze the trade for you guys.
Yeah, exactly.
Oh, on that Devo chart, I was looking at yesterday and the day before's price action, and we're looking at those levels. When it broke down from those levels, we knew 12 was around the corner, and you know, the 12 was the target on that short. It wasn't based on SMAs or EMAs. It was literally based on the candlestick and the pattern, right? Like, I like to draw like a box where you think it's the strongest support, or draw lines where you think it's strong resistance, and draw multiple lines. If you see a lot of these candlesticks just like touching each other, you know, on like a 3-day chart, draw lines. And what you'll notice is the areas where the lines are the closest, those are strong resistance or support levels, right? That's the easiest way to look for it. Right now, like we can do it visually. We've like done it so many times that it's much easier, right? But when you do start, just draw lines. Trust me, you'll draw horizontal lines across it, and you'll see it. So it's something that I still do, and you guys noticed on Jibo when I was trading it yesterday. I posted those charts. I had lines drawn. I know exactly where it could go, where it could go against me, and where it could go in my favor. And I knew which points I was going to scale out before I even took the trade. So whenever we hit a certain level, I know when to enter or when to execute those trades. Oh yeah, the pivot points are just pivot points. Just like, actually, I don't remember what we did. The 1650. What happened today at 1650? Let me check. Honestly, it was just a total breakdown. Like, as soon as I knew yesterday, like we were struggling to get, you know, like that was the area that we couldn't break in pre-market. That $16, $17 level, right? So as soon as that area got destroyed, we know that we just took out yesterday's gains, and all we have to worry about is the day before's gains. No problem, Jay-Z. All right, guys, I'm gonna head out right now.
Yes, sir. Thank you, TJ.
Oh, thank you guys, and honestly, thank you, Frank, for helping me out. Ziggy, all of you guys, thank you. Um, Voltog. Okay, I think you need to look at like a 5-minute chart, and you'll be able to see it a lot clearly.
Hey guys, thanks for everything today. Appreciate it.
Yeah, no problem. I hope it helps. And if you guys have questions, well, I think we're gonna stick around. I think the feed's gonna be done soon, but you know, me and Frank will just stick around. And if you got any questions, just ask. Best time to ask.
Yep.
I'm just saying, for all new members who came, you should commend yourselves for coming, just because it's so easy to just stay quiet and like stay shy sometimes. Like, there's no reason to be here because you're only going to help yourself by coming and by asking the questions rather than just watching it in hindsight or just being quiet. So
Yeah, and ask questions, guys. That's the only way you'll understand anything you do. You know, you have to learn, right? If there's something you don't understand, ask us, and we'll try and explain it to the best of our abilities. Sometimes it's hard. Sometimes we're so used to a certain thing that we overlook the importance of it because it's just something that it just clicks into our head. It's something we just naturally do, right? But for new traders, it could be a make it or break it moment, right? It could be like aha moment. So yeah, try and ask anything you want.
TJ, I talked to JC. He should be wrapping it up as we speak.
All right, perfect. And also one more thing I want to add. You know, guys, we're amazing traders. That's what we do for a living. We're not marketers, okay? We're not the guys that sell ourselves on Instagram saying you can buy this if you do this, right? But our marketing team is, you know, lagging a bit. So if you guys can, you know, invite your friends, spread the word. Word of mouth is how we grew this chat room, and I want to continuously use that instead of marketing gimmicks, right? Because we're not here to trick anyone, and using marketing gimmicks, it really takes away from what we feel is adding value to you guys, right? We shouldn't have to convince you guys to improve yourselves, right? We want guys that are hungry, that want to learn, and that want to trade with us and learn, and we're willing to help, right? At any moment.
Hey TJ, speaking of, do we have a specific link as far as that goes that you want us to use?
Are you guys able to make links? Like, if you honestly, any of the links work? I think we have a command for it. Let me check.
I didn't know if there was a specific one or.
Oh yeah, if you use exclamation mark Discord, it'll pop up a link.
Okay.
Yeah, and if you like look on the right side, you should be able to see it as well. Like on the channel listing, there's something that says create instant invite. And thank you guys. You know, a referral means a lot to us. It means we're doing the right thing, right?